investing in 10 different bite-sized steps. So the first one is forgetting about investing completely and just thinking, what happens to my money over time by default? And if you've studied economics, you'll know that your money loses its value over time thanks to something called inflation. Inflation is generally around about the 2%, 2.5% mark. And so that means that every year stuff costs about 2% more than it did the year before. For example, in 1970 in America, a cup of coffee cost 25 cents. But in 2019, that same cup of coffee cost $1.59. That is inflation in action. And so let's say you've got £1,000 in your hand right now, and for the next 10 years, you just stash it under your mattress and you never look at it again. In 10 years' time, your £1,000 is not going to be worth £1,000 anymore because everything will have increased by 2%-ish every year. So the value of your money will have fallen. And so if you put your £1,000 under your mattress for 10 years, you will lose money over time, and this is obviously not good. Even if you put your money in a savings account, like these days, a savings account will give you like 0.2% interest, which means your money goes up by 0.2% every year. But because inflation is up by 2%, you're still losing money over time. And again, this is not good. Okay, so that begs the question, which is key point number 2, which is how do we stop our money from losing value over time? And the answer is that if we had a hypothetical savings account, one that was, let's say, an interest rate of 2.5%, that would match roughly the rate of inflation. So inflation means everything goes up by 2.5% in terms of price, but our money in our savings account also goes up by 2.5% each year. Therefore, we're technically not losing money over time. If you're watching this and you have an issue with the word interest, then don't worry, stick to it for now. Investment is not the same as interest, but we'll come back to that a bit later. But the point here is that we don't just want to not lose money, which is what happens at our 2.5% rate. We actually want to make money. And that brings us on to question number 3, which is, well, how do we actually make money? Now, let's go back to our hypothetical savings account. If, hypothetically, we could have a savings account that was giving us a 10% interest rate, this will never happen because that's just way too high. But hypothetically, if it did, that means that every year we'd be making 10% of the value of the money in our savings account. So for example, if I were to put £100 in a savings account right now, then next year it would be worth 110. And then the year after it'll be 121 because it's 10% of then the 110. And then it would be 130 something. And this would very quickly compound so that in 10 years time, my £100 will have become £259. And if we adjust for inflation, then our money is still worth £206 in 10 years time. This is pretty good. We have more than doubled our money by just putting it in this hypothetical 10% interest savings account. And it really doesn't seem like it would do that because 10% feels like a small amount of money. But if you extrapolate 10% over 10 years, you actually double your money, which is pretty awesome. Sadly, these hypothetical 10% saving accounts don't really exist because it's just way too high and real life is not that nice. These days, most savings accounts in the UK, and I imagine around the rest of the world as well, offer less than a 1% savings rate, which means you're actually still losing money over time. But we do have other options to try and get us to this magical nirvana of like, this 10% saving thingy. And that is where investments come in. So point number 4 is, what is an investment? And the answer is that an investment is something that puts money in your pocket. For example, let's say you buy a house for £100,000 and you want to rent it out to people. There are 2 ways that's an investment. There are 2 ways you're making money from it. Firstly, let's say you're charging some rent to the people living in your house. Let's say you're charging them £830 a month. That becomes £10,000 a year. And so every year you are making £10,000 in rental income, which is 10% of what you originally paid for the house. That means that in 10 years' time, you'll have paid off the £100,000 that you put in because you're making 10K a year. And beyond that, every year, you're just making £10,000 in pure profit. So that's pretty good. But secondly, it's an investment because the value of the house itself would probably rise over time. In general, there is a trend in most developed countries that house prices tend to rise over the long term. And so your house will probably be worth more than £100,000 in 10 years' time. And in fact, in the UK historically, in the past, some people have said that house prices have doubled every 10 years. So maybe your house is worth close to £200,000. And so you've made money off of the rental income, but you've also made money off of the capital gains, which is what we call it when an asset increases in value over time. But the problem is that buying a house is a little bit annoying. You need to have quite a large amount of money for a deposit. You need to get a mortgage. You need to actually have the house. You need to sort out the rental management, rent it out to people, all of that kind of stuff. If only there were a way of investing without A, having a large amount of money to start with, and B, without having to put that much effort into managing the asset as well. And that brings us on to investing in shares. And for me, basically 100% of my investment portfolio is entirely shares. I have a tiny percentage in Bitcoin, and I own this house, but I don't consider this house an investment. I'll talk about that in a different video. Therefore, point number 5 is, what are shares and how do they work? So buying shares is probably as close as we're ever going to get to this magical savings account that just returns some amount of money each year. And the idea is that when you buy a share, you are buying a part ownership of the company that you've got the share in. For example, let's say that Apple have a particularly profitable year because lots of people have bought iPads as per my recommendations, and because Apple are feeling kind, they are choosing to pay out a dividend to their shareholders. So for example, they might say that they're going to issue a dividend of £1 million, and that's going to be split evenly amongst whoever owns shares in Apple based on how many shares they own. So for example, if you happen to own 1% of Apple, you would get 1% of that dividend that they've issued. So 1% of £1 million, which is £10,000. Obviously, no one watching this actually owns 1% of Apple, unless Tim Cook you're watching. I don't even know if you own that much, because that would make you an extremely rich person, because Apple is a very valuable company. But that's basically how the dividend thing works. A company decides to issue a dividend as a way of returning some of its profit back to the people who have invested in the company, and therefore you make money through dividends. The second way of making money from shares is sort of like with houses, in that you get the capital gains over time. So for example, let's say you bought 10 shares in Apple in 2010. At the time, those shares were selling for $9 each, so you spent $90 on buying 10 shares in Apple. As of October 2020, Apple shares sell for $115, so your 10 shares are now worth $1,150, despite the fact that you only paid $90 for them 10 years ago. Okay, so we've talked about what a share is and how you make money from them, and at this point you've probably got a few questions like how much money you need to get started, or how risky is buying shares in a company, and I promise we're going to get to that. But point number 6 is, how the hell do you buy a share in the first place? And this is where it can kind of get complicated, because it's not as simple as going on apple.com/buy and just buying a share in Apple. It doesn't quite work like that. Instead, you have to go through what's called a broker, and back in the day, a stockbroker was a physical person, usually a dude, who you would call on the phone and say, hey Bob, I want to place an order for some shares in Apple. And then Bob would type some stuff into his computer or place like a paper order, and then you would own shares in Apple. Thankfully, these days, we don't really have to talk to Bob, because there's loads and loads of online brokers instead. And so you make an account on an online broker, and then you can buy shares in a company through that. A bit annoyingly, every different country has their own different brokers that operate in that country, because to be an online broker in a country, you have to abide by like a zillion different laws. And so in the UK, the system is different to the US, which is different to Canada and Germany and so on. In the UK, for example, most banks do have their own online brokery type thing. So with most bank accounts, you can also open an investment account with them and then invest online. But usually the interface is a bit clunky, it's a bit old fashioned, and so you're usually better off going with an online broker. In the UK, the two that I use are Charles Stanley Direct and Vanguard. But before we get ahead of ourselves and make an account on Vanguard or whatever, we need to understand a few more things. And so question number 7 is, how the hell do I decide which shares to buy? And the easy answer to that is that you actually don't want to figure out which shares to buy. You do not want to buy individual shares. And I'm going to tell you a little bit more about that once I've had a haircut, so see you shortly. All right, so new hair. I've got my Invisalign braces on, so I'm going to sound a little bit different, but where were we? Oh yeah, we were talking about why it's not a good idea, generally speaking, to invest in individual stocks. And I'm going to do a video about this some other time, but essentially the issue with investing in individual stocks is...
So you want to know where to invest $1,000 right now? Well, forget about stocks, real estate, or cryptocurrency. There is a little known trend taking America by storm right now called digital real estate. And digital real estate creates online assets that have the potential to generate income and grow in value over time, just like physical real estate. In fact, it's one of the easiest ways for regular Americans to take advantage of this emerging industry. So you want to know how you can get started with digital real estate? Well, stick around for the next 60 seconds and I will show you how. Hi, my name is Jeff Lerner, and I did not become a multimillionaire the traditional way. I didn't work 40 years for the man, didn't invent anything, definitely didn't inherit a trust fund or win the lottery. But what I did do is take advantage of digital real estate. And since then, I've generated over $80 million, been on the Inc. 5000 list twice, won a bunch of other awards, and most importantly to me, I've helped tens of thousands of other people learn about digital real estate. And now, for the first time ever, I'm sharing how you can unlock the secrets of digital real estate and create an awesome life, all inside a super simple short book called The Millionaire Shortcut. And I'm not going to do this forever, but for right now, it is 100% free. No catch, no shipping costs, and no credit card required. And I'll send this right to your email and you can download it instantly. So click the link on your screen right now. Go to my website and enter your email to download your free copy. And this book, is less than 20 pages. You can be reading it in the next 5 minutes and you'll be done in the next hour. And I promise it's gonna be the most powerful book that you'll ever read on how it can be possible to take advantage of digital real estate and create your legacy in this new economy. Did you know that every single day in America, according to Forbes magazine, there are over 1,700 new millionaires created? And it is more than double that across the globe. People are becoming millionaires now faster and easier than ever before. But how do they do it? And more importantly, can an average American do it too? Well, that's exactly what you're gonna learn about in this book. Plus, after you get the book, I'm gonna give you access to a free bonus video training that shows you exactly how I build digital real estate, as well as the blueprint for how you can apply it in your life. So you'll definitely wanna make sure you watch that entire video. So with that said, click the link on your screen, enter your email address, and I will send you a free copy of the book right away. Plus, you'll get the free bonus training on how to apply all of this to your life.
So it's 10:30 on a Wednesday, and apparently I've sold close to $3,000 in sales on Amazon already. Don't believe me? Come around, I'll show you. So as you can see, we're at $2,800 in sales, and the time right now is only around 10:30. And just to show you that is not some sort of a luck, what I can do is I can actually drag my calendar and show you our last month sales, and you can see that we've made close to $300,000 in sales already over the last 30 days. Now, I know what you're asking, Tom, that's in sales. How much money are you actually making that putting into your pocket? Well, an average Amazon seller makes anywhere between 30 to 40% profit margin. So if your sales is, let's say, $100,000, then around $30,000 of that will be your net profit, which is pretty amazing, right? Now, this is the everyday life for me, as well as a lot of Amazon FBA sellers as well. By the time I roll out of bed, a few $100s has been deposited into my bank account. I get up, I go to kickboxing class, I walk my dog, and by dinner time, another few $100s has been added to my bank account. Even though the money is good, the best part of this is that you get your time back. Just imagine what life would be like if you got paid every morning while you're still in bed. And throughout the entire day, no matter what you're doing, you could be eating, watching a movie, or even fighting with your spouse, you will still get paid. No clocking in, no manager telling you what to do, no people to get back to, no meetings to join either. To make a living, it's just you, your computer, and your Amazon business. Why is this business so hands-off? It's because with the Amazon business, you're mostly doing one-time work that can pay you up to years. Like the 3,000 something dollars I sold today, I probably set those up like 2 years ago. I'm still making money from it today. And that's for real, no BS. With this business, your work is what I call front-end loaded. So 90% of your hard work happens early on the front end, then once this is done, the rest is just maintenance. So you're kind of just tweaking small things here and there a few times a month. And the crazy part is that the front-end work I'm talking about isn't even that hard. Most people who have a way easier time selling on Amazon than, say, learning accounting. So I'm not twisting your arm to convince you why you should start selling on Amazon. It's obvious that Amazon's gonna keep taking over the world and everyone shops on Amazon. So for the person who knows this, I've got a super hands-on training in the link below. In this training, you'll get a step-by-step tutorial on how to get started and a crystal clear idea on the front-end work you need to do. It's 100% for free. It's 50 minutes of pure gold content you won't find anywhere else. And you can improve what you learned right away. If you want to, I promise you selling on Amazon is as good as it gets. By the time you make your first $100 in passive income on Amazon, you will change as a human being forever. And you will never want to go back trading time for dollars ever again. And this isn't just for people who are super smart. I've helped dozens of people get paid while they sleep, eat, and fight with their spouses. Everyone from mechanics to nurses to engineers to stay-at-home moms. So to get your time back by using what I show you in the training down below, click on it. Even if you only make a few $100s a month with Amazon, who cares? It's a one-time work you could potentially get paid for a very, very long time. So I'm gonna keep the training up for free for the rest of the day. Check it out. Okay, that's all I wanted to share for now. I'm going to get back while I play with my dog now.
It's kind of risky. Like, yes, if you invest in something like Apple, chances are it's going to be around 10 years from now. But historically, there have been quite a few companies that people were like, oh my God, this is amazing. This is the thing to invest in. And then that company went bust. So you're automatically exposing yourself to more risk if you are investing in individual stocks. Also, in general, like, it's easy to say, hey, Amazon grew 10x in the last 10 years, therefore it's going to continue to do the same for the next 10 years. But that's trying to predict the future, and the past is no real indication of future performance. And so the advice that most people would give for beginners is that you should not invest in individual stocks, you should invest in index funds. And this is what Graham Stephan, one of my favorite YouTubers, also says as well. He says that index funds are the best, safest, and easiest long-term investment strategy for most people, which begs the question, point number 8, what the hell is an index fund? So there's basically two bits to understand here. There's the index bit and the fund bit. Let's start with the fund bit. And a fund is basically where investors will pool their money. So multiple investors would invest in the same fund. And then that fund would have a fund manager, and the fund manager decides which companies the fund is going to invest in. For example, let's say I were managing a fund and I called it Gringotts, and let's say 100 people from my audience decided to invest in my Gringotts fund. I, as the fund manager, can say, okay, the Gringotts fund, now that we have 100 people's money, let's say it's 100 million, so everyone's invested 1 million each, I've now got 100 million, I'm gonna put 20% of that in Apple, 10% in Facebook, 10% in Amazon, 10% in Tesla, 10% in Netflix, 10% in Johnson & Johnson, all of that sort of stuff. And so you, the investor, don't have to worry about this because you trust me and my fund Gringotts to manage your money. And as the fund performs well, because the prices of these stocks and shares increases, you get the returns and I take a 1 or 2% management fee. So I make a load of money because I'm earning 1 or 2% off of this 100 million that I'm managing, and you're not worrying about having to pick stocks yourself. You trust me as a seasoned professional to do that for you. So that's what a fund is. Now, the index bit refers to a stock market index. And so a stock market index would, for example, be the FTSE 100, which is the 100 biggest companies in the UK, or the S&P 500, which is the 500 biggest companies in the US, or the NASDAQ, or the Dow. And these are all different indices of the stock market. And if we use the S&P 500, for example, these are the components of the S&P 500. So we said it's the 500 biggest companies in the US. So number 1 is Apple, and Apple makes up 6.5% of the S&P. Microsoft makes up 5.5, Amazon makes up 4.7, Facebook is 2.2, Alphabet, which is Google, makes 1.5 and 1.5, so about 3% of the total S&P 500. And essentially, we've got these 500 companies. If you go all the way down, Ralph Lauren is 496, but chances are you've not really heard of many of the other ones at the bottom of the list. But chances are you've heard of most of the companies towards the top of the list. So the S&P 500 is an index of the US stock market. And if you look at the performance as a whole of the S&P 500, you get a general idea of how the US economy is going as a whole. So this is currently what the S&P 500 looks like. And if we do a 5-year time horizon, in fact, let's go max. So you can see, the S&P 500 started in 1980. And since that time, this is what the US stock market has been doing. So, as you can see, there is a general trend upwards. But for example, in 2000, there was a bit of a crash. In 2008, famously, there was a bit of a crash. And earlier this year, when Corona was first starting to be a thing, there was a bit of a crash. But then the market basically immediately recovered after that. Okay, so we know what a fund is, i.e. a way of pooling money, and we know what an index is, like something like the S&P 500. When you combine those, you get an index fund, which is a fund that automatically invests in all of the companies in the index. And so with me, for example, basically all of my investments, all of my money is in the S&P 500, which effectively means that 6.5% of my investments are in Apple, 5.5 are in Microsoft, 4.7 in Amazon, 2.2 in Facebook, 3% in Google, 1.5 in Berkshire Hathaway, and so on. So why is this good? Well, it's good for a lot of reasons. So firstly, index funds are really, really easy to invest in. A big problem that beginners have to investing, it's like, well, how the hell do I know which company to invest in? How do I read a balance sheet? How do I do any of this stuff? If you invest in an index fund, you actually don't have to worry about any of that. Secondly, index funds give you a decent amount of diversification. There are all sorts of companies in the S&P 500, so you're not entirely reliant on the tech sector or the oil sector or the clothing sector or anything to make the bulk of your money. You are very nicely diversified across all these US companies. Thirdly, index funds have very low fees. So because it's not a real person who is deciding, what to invest in and doing all this research and trying to make loads of money, it's essentially a computer algorithm that automatically allocates your money, based on the components of the index fund. The fees for those are really low. And one of the main things about investing for the long term is that even a slight increase in your fees is going to massively impact your financial upside. And so, for example, an index fund with a 0.1% fee is so much better for you than an actively managed fund where a fund manager is charging you even 1%, because the long-term difference between 0.1% fees and 1% fees is sort of absolutely astronomical over the long term. And finally, if you look historically, and technically historical performance is not the same thing as future performance, but if you look historically, very few funds have managed to actually consistently beat the market, i.e. outperform the index. And in fact, someone like Warren Buffett famously says that if you gave him £100,000 and asked him to invest it right now, he would just invest in an index fund like the S&P 500. And in fact, in 2008, Warren Buffett challenged the hedge fund industry to try and beat the market. He said that hedge funds are a bit pointless because they charge way too high fees and they don't actually get the sort of returns they claim to get. And so he set up this 10-year bet, which this company called Protégé Partners LLC accepted, where Buffett said that he was going to bet that the index fund outperformed the actively managed fund. And he ended up winning that bet and sort of gave lots of money to charity or something like that. But that just sort of goes to show that it's really hard to beat the market with an actively managed fund. Basically, no one can predict what the market is going to do in the future. And therefore, if you hitch a ride on an index, i.e. you're gambling on the entire market, rather than thinking, you know what, I've got some kind of amazing insight that I'll know exactly which 10 stocks to pick that are going to beat the market, you might as well hitch a ride with the whole market rather than individual stocks. Okay, so we've sorted out the problem of which stocks to invest in by completely circumventing the problem and instead just investing in index funds. The next big question people usually have about investing in stocks and shares is the amount of risk. And that brings us to point number 9. And the argument usually goes as follows, that, hey, okay, cool, this investing in stocks and shares stuff sounds kind of interesting, but my uncle Tom Cobley invested lots of money in the stock market and he lost a load of money, and my parents have told me that investing in the stock market is a really risky thing and I shouldn't do it, and I should instead invest in real estate because real estate is safe. That is usually the sort of thing, the sort of idea that people have about investing in stocks. And naturally, there is the anxiety of what if I lose all my money? So let's talk about that now. So if we take a step back, the only way to lose money in anything is if you buy a thing and then you sell it for less than you actually bought it. Like, let's say you bought a house for £300,000 and then Brexit happens the next day and house prices plummet and now your house is only worth £250,000. At that point, if you decide to sell your house, then yes, you are losing money and you've lost £50,000. Equally, the only way to really lose money in stocks is if you buy a stock at a certain price and then you sell it for less than that price. So for example, let's say you bought shares in Apple on the 18th of February 2020, and let's say you bought one share, which at the time was $79.75. And because this is your first time investing, you keep on looking at the price of the Apple stock because every day you're thinking, oh, have I made money? Have I made money? And really annoyingly for you, you see that over the next kind of few days, a few weeks, Apple stock is actually going down. And then on the 18th of March 2020, you decide, screw it, I'm going to sell my one share in Apple because I don't want to lose all my money. And you sell it for a measly price of $61.67. And so you technically lost $18 because you bought it at $79 in February and you sold it for $61 in March. Then you think, damn, I've lost 20% of my investment. This stock market thing is BS. I'm never going to invest in the stock market again. And you call it a day. Now, this would be a very bad thing to do because, for example, if we look at Apple's stock price in March, it was $57.31. But if you just held on to your one Apple share, in that time, what is it today? It's the 8th of October. Apple is now trading at $114.96. So if you just held on for a few months, you would have actually made a lot of money. You would have bought it at $79, and within, 8 months, it would now be worth $115. That's a pretty good gain. And so the real lesson here is that when you're investing in stocks and shares, and also when you're investing in real estate, these are long-term investments. Ideally, you shouldn't be putting any money into stocks and shares that you need to access within the next 5 years. And actually, a lot of people would extend that to 10 years. And it's exactly like that with house prices. It's like if you buy a house as an investment, and then the house prices go down, it would be completely stupid of you to sell the house unless you are absolutely desperate for the money because something major has happened. And instead, if you just held on to the house, then you would have made more money in the long run, because in the long term, house prices always go up. And in the long term, basically, the stock market always goes up. And that's it can be a controversial statement. It is true, but I'm going to make a video at some other point explaining why it's true. But for now, take my word for it that over the long term, the stock market always goes up. But having said that, again, this is a long-term thing. And so, for example, if we look at the S&P 500 and look at how it was in 2008 at the financial crash, right, in 2007, it's $1,500. per bit of the S&P 500. And then the crash happens, and then by, February 2009, it's down to 735. So basically, 50% of the value has been wiped off out of the S&P 500. Now, if you bought it in 2007 and you saw it, crashing and crashing and crashing, and then you sold when it was $800, now you've lost a lot of money because you've bought high and you've sold low. But if you just held on, it took, let's see, June 2007, it's at 1500. It takes about, up until 2013, so it takes about 5 years for it to get back to its normal level. And even if you'd invested like just before the crash, and then your investment plummeted by 50%, if you had just held on, you'd have bought in at the S&P 500 at 1500, and right now it would be 3,445. So since 2008, 2007, when you first invested, over the last 13 years, the S&P 500 has more than doubled. So you would have more than doubled your money, provided you did not panic sell when the market crashed. Now, hypothetically, could the market crash down to zero and therefore you will actually lose all your money? Yes, it could. But if the US stock market crashed literally to zero, i.e., all top 500 companies, including Apple, Google, Microsoft, Facebook, like literally every company in the top in the S&P 500, all of those got destroyed overnight and the stock market crashed to zero, the world would be in some sort of mega apocalypse, and you'd have a lot more serious problems to worry about rather than the value of your portfolio of stock market indices on Vanguard. In that scenario, in that doomsday scenario, money would stop meaning anything and you'd be using money to wipe your bum because money has no value because the stock market has completely crashed. It's basically unfathomable that the global economy could be so completely wrecked such that every single company goes down to zero. In my opinion, and again, I'm not a financial advisor, this is technically not financial advice, whatever that means, but in my opinion, it's unrealistic to think that if I put my money in stocks and shares, I could lose all of it. There's basically no way you're ever going to lose all of it, provided you're diversified. If you invested in, MySpace in 2000, whenever it was, and then MySpace crashes, and then you've lost all your money because, they have no money. But if you invest in the top 500 companies in the US, or, the top 500 companies in the world, or the top 100 companies in the UK, it is so vanishingly unlikely that you'll ever lose your money that I don't think that is a risk that we should even be thinking about. So realistic worst case scenario, yes, investing in the stock market is risky in the short term, but if you're investing in the long term, the market will always go up and you will always end up making more money in the long run, provided you don't have to take money out at inopportune times. Okay, so at this point, we've established that investing in stocks is very good and investing in index funds is a relatively safe way of doing this. The next question is usually, when should you get started? Like, how old do you have to be? Is it ever too soon to start? Is it ever too late to start? And here the answer is pretty simple, and basically all investment advice agrees with me on this front. There's a very good website called The Motley Fool at fool.com, and they have a nice article explaining this. Basically, you should start investing as soon as possible. It doesn't matter how old you are. It doesn't matter how young you are. The earlier you start investing, the better. There are 3 caveats though for sensible financial advice. Firstly, you want to make sure that all of your high interest, i.e. credit card debt, is paid off. Because when it comes to compounding, even though gains compound, losses compound as well. And so if you've got a 6% credit card debt, that's eating into your bottom line every single month. You want to pay that off as soon as possible. Point number 2 is that you want to make some sort of emergency fund. And people usually say that your emergency fund should have in cash, basically 3 to 6 months of living expenses, so that if you lose your job or if you're hit with some kind of incredible medical emergency and you're not in the UK where medical care is free, or you're in the US or something like that, then you've got money to do that and you don't have to take money out of your investments. And caveat number 3 is that you don't want to put any money into stocks that you think you might need to use in the next 3 to 5 years. So let's say you're 24 and you've just landed your first job and you're thinking of getting a mortgage and buying a house and you need money for the deposit. Do not put that money into the S&P 500 or into any kind of stocks and shares, because no one can time the market and no one knows whether there might be a market crash tomorrow. All we know is that in the long term, the stock market goes up. But if you need to buy a house next year, there is absolutely no guarantee that that money will still be worth exactly the same or worth more this time next year. So provided those 2 conditions are met, firstly, you have no high interest credit card debt, and secondly, you've already got your emergency fund, and thirdly, you're not planning to have a major expense in the next few years. At that point, absolutely everyone should be investing something into the stock market, in my opinion. Whether you're 12 or 20 or 21 or 22 or 50, it doesn't matter. And as they say on the Motley Fool, there is almost no way your future self will regret making the decision to invest. And as you'll know by this point, this is because of compounding. The more time you leave your money in the stock market, the more it compounds. And there is a huge difference. There's like lots of interesting numbers about this on the internet that people have calculated, that if you start investing at the age of 20 versus if you start investing at the age of 25 or 30, it makes such a huge difference to your bottom line that basically as soon as you watch this video and hear about investing, you should start investing, provided those 3 conditions that we talked about are met. All right, so we're nearly there. Now we're point 11 out of 12, where we've said, okay, you sold me on this idea of investing in index funds. All of these 3 conditions are met. I don't have a high interest credit card debt. I've got my emergency fund, or I'm a student and therefore my parents are in my emergency fund. And I'm not planning to buy a house or a big thing in the next 3 years. The next question is usually, how much money do I need to get started with investing? And I know a lot of students watch my channel, and I had a lot of comments on Instagram saying, I'm 14 years old and I don't have any money. How do I get started with investing? And the answer here is, again, quite easy. Basically, start with whatever you can. So some of these websites and some of these apps that you can use to invest in stock market indices, you can start with as little as $5 or £10. Depending on the website, you might need to start with £100 or £1,000. You can research this, and it kind of depends on which country you're in. But basically, you want to start investing as soon as possible, and it doesn't matter if it's a tiny amount of money to begin with. Firstly, it's useful to invest small amounts of money because compounding is always good. But secondly, and more importantly, the sooner you start investing, the sooner it becomes a habit. And so for me, for example, I started investing in 2015. I knew absolutely nothing about it before then, but I really wish I'd started investing in like 2009 when I first had my first part-time job. Because A, that would have encouraged good financial habits within me. I would have kept aside maybe 10% or 20% from the top line to put into my investments. Secondly, it would have meant that investing became a habit. And so I would have known about the fact that stock market indices exist. I would have done the research. I would have watched videos like this, although these weren't really a thing in 2009. And what I'm really annoyed about with myself is I started making actual money in like 2012 when my first business started to do very well. And between 2012 and 2015, I did not invest any money just because I didn't know that you could and I didn't know how. And I always kind of thought that, I'm making money now. It's just sort of sitting in my bank account. And I know that inflation's a thing, so I know my money's losing value, but I just didn't think about investing and didn't realize how easy it is and that it's a thing. And so I really wish I'd started investing my real money in 2012. But the only way I would have done that is if I had started investing from 2009, when I first started making, I don't know, £6 an hour during my part-time job. So again, and I can't state this emphatically enough, like it doesn't matter if all you have is a small amount to invest, even if it's £1, even if it's 10p. The process of making the account and researching online stockbrokers in your country and figuring out how to actually do this stuff is like the most valuable thing that you could be doing with your time immediately after watching this video. And finally, point number 12 is, okay, I'm sold. I've got £100 here and I want to put it inside a stock market index fund. How do I actually do that? And the answer here is you want to find an online broker. So this will vary massively depending on which country you're in, because these online brokers, as I said, have like zillions of laws they have to comply with and financial regulations and all this stuff. In the US, most people that I know use Vanguard as well, and my favorite blogger, Mr. Money Mustache, recommends that as well. Although in the US, there are also other services like Betterment, which I've got a few friends who use that as well. Again, depending on which country you're in, like literally all you have to do is Google the phrase best online broker Germany, or best online broker Pakistan, or best online broker India, or whichever country you're in, and you'll find something, read some reviews. Basically, the thing you're looking for is you want to be able to invest in index funds and you want the fees to be as low as possible. I think Charles Stanley Direct, the fee is 0.25%, which was the lowest at the time when I made my account, and I think is still pretty competitive. So you want the fee to be like a really, really, really small fraction of a percentage. Then once you've made your account and verified your identity and gone through all the hoops and stuff, which sometimes takes a few days, and they send you a letter in the post to verify your address, like depending on what the regulations are. Once you've done that, then you can start just putting money in here and there. And all the friends that I've spoken to about this stuff over the last like 4 years since I first started knowing about investing and things, they've all started making accounts and sort of making these investment accounts for themselves. For the first few weeks, they all sort of compulsively check their phones to see what the stock market is doing. But then very quickly you realize that actually I'm investing for the long term here. I actually don't give a toss what the stock market is doing in the short term. I'm going to check I check my portfolio once every 6 months just because sometimes I'm curious. I don't even bother looking at it. This is very much a set it and forget it strategy. You're investing for the long term. Your money will magically grow over time, provided you don't touch it and think, oh crap, the stock market's going down a bit. I'm going to take my money because I can't handle these losses. There's loads more to say about investing in finance, but hopefully this was a reasonably concise, not very concise, this is going to be a long video, but oh well. Hopefully this was a reasonable introduction on how to get started with investing in index funds. If you have more questions about exactly what to do or anything else about money, do leave a comment in the video description area thing. I'm still trying to think of a name for this series. I was thinking, I posted on Instagram, there were a few options. Money Talks was quite a popular one, but that's already a film. One that I really liked was Penicillin. I think I might call the series Penicillin. That was kind of cool. A lot of people said like Financially, because my name's Ali, get it? Financially. A few different options. Let me know what you think. If you have any ideas for what this entire series about money and stuff should be called. And final piece of advice, if you're in the UK, if you're in the UK and you're just getting started with investing, basically go on a Hargreaves Lansdown and make a lifetime ISA. The lifetime ISA is a very good deal. You can read more about it on moneysavingexpert.com. Within the lifetime ISA, as of 2020, you can put up to £4,000 a year into it, and then you can invest that in the S&P 500, which is what I would do. If you have more than £4,000 a year to invest, you can then put another £16,000 into a stocks and shares ISA, which I'd recommend doing on vanguardinvestor.co.uk. And if you have more than £20,000 to invest in a year and you're doing really well, then just open a general investment account with Vanguard. This is what I do. I think it works great. Loads more links in the video description to other resources and bloggers and books and other videos that I would recommend. Graham Stephan, amazing YouTube channel. Andre Jick does a good job with YouTube channels as well. Mr. Money Mustache, amazing blog. JL Collins, amazing blog with a fantastic stock series that you should definitely read. There's so much to explore in this area and it's a really fascinating topic, but thank you so much for watching this video. Hit the video here if you want to learn about how I make the money that I use to invest. It's my video about how to make money online. Thank you so much for watching. Good luck with investing. Make sure you invest in a stock market index fund, and hopefully I'll see you in the next video. Bye-bye.
Liberty, 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 liberty.
In this video, I'm going to talk you through my entire investment portfolio that I've been building up since I started investing in 2015. We'll talk about stocks and shares, index funds, crypto, real estate, angel investments and startups, and a few other bits and bobs. And I'll share the lessons I've learned along the way investing in each of these asset classes. So if you're thinking of getting started with investing, or even if you're a seasoned pro, hopefully there'll be something in here that you can, fingers crossed, theoretically, hopefully learn from. Now, before we get started, I'll say the usual caveats that I always say when I'm making a video associated with money, and that is number one, this is not financial advice. It's purely for informational/entertainment purposes only. Genuinely, I have no idea what the hell I'm talking about. I've read a few blog posts and a few books about like money and investing and stuff, but beyond that, I don't know anything, so please take every single thing I say with a huge bucket of salt. Caveat number two, we are still sadly in the middle of a pandemic where people have been struggling financially and have lost their jobs. The point of this video is not to #flex, and to be honest, my investment portfolio is nowhere near as impressive as other YouTubers like Andre Jick and Graham Stephan's are, so you can check out those if you really want to see a flex. But whatever the case, especially if you or people that you know have been struggling financially, it's often not useful for our own mental health to compare ourselves to other people and to see kind of what they're doing. So please consider this a trigger warning. I'm going to be talking candidly about money. I think it's a good thing to do overall. I think it's a net positive that more of us should talk about money. But whatever the case, I trust that you know that if you're the sort of person who will find yourself kind of going into that spiral of comparing yourself with other people, please don't watch this video. You don't have to. I'm not forcing you. No one's like propping your eyes open with a matchstick or anything like that. There are many better things you could do with your time. Many better videos you can watch on YouTube. There's probably a few suggested right there. Don't watch this video, please, if you're in that boat. And caveat number three, this stuff has taken a long amount of time to build up. I have been making money on the internet since the age of 13, and I had 7 years worth of failed businesses before, at the age of 19, in my second year of med school, I finally made a business that actually succeeded and actually made an interesting amount of money. And so what you're going to see in this video is 7 years worth of trying and failing to build businesses, and then another 6-7 years on top of that of building on top of something that's been successful. And to be honest, when you do anything for 13-14 years, you're probably going to get pretty good at it. But the point I'm making is that this is not a get-rich-quick scheme kind of thing, and in the slightest, this is very much a long game, but it's fun. And so if you're at the start of your journey, don't be disheartened. It takes a while, but hopefully if you keep at it, then maybe good things will happen further down the line. So with all that said, let's get started with the investment portfolio, and let's start with stocks and shares. I've been investing in stocks and shares since 2015 when I first decided to get started with investing, and I've got a video over there which is the ultimate guide on how to get started investing in stocks and shares, which is a half-an-hour long introduction, basically everything you need to know to get started with this sort of stuff. Within stocks and shares, there are broadly two types of things that I invest in. Number one is index funds, and number two is individual stocks. So index funds, firstly, I mostly invest, basically all my money is in the S&P 500. This is an index fund which is made up of the 500 biggest companies in the US. And so what that means is that if you invest, let's say $1,000 into the S&P 500, then like $40 will go to Apple, $30 will go to Google or Alphabet, some $20 go to Microsoft, $20 to Amazon. So it's like all these big companies And by investing in the index fund, it's almost as if you are putting a small amount of money into each of these big companies, weighted by their market cap, i.e. how big the company is. Why do I invest in index funds? Well, because Warren Buffett says so, and because every financial advice type book that I've ever read says so. Like, there's no point in trying to pick individual stocks and trying to beat the market, because that's not really a thing. Far more details in my investment video, but let me show you how much I've got. So basically, I'm with two providers. The first one is called Charles Stanley Direct, based in the UK. And that was what I first got started with investing. And so far I have put in £75,959 into my ISA, which is an individual savings account or something like that. It's like a tax-free wrapper in the UK, whereby every year you can put 20,000 into that, and then any gains you make are completely tax-free. So I've been maxing out my ISA since 2015, which is why this has a decent amount of money in it. And its current value is 124,960. And so the change in value is 49,000. Now this is pretty staggering. This means that I've just been putting money into this account and then completely forgetting about it. And over the last 6 years of putting money into this account, it's made £49,000. That is utterly ridiculous. And that's sort of why I got started with investing in 2015, because before that point, if I made any money, it was just sitting in my bank account and depreciating thanks to inflation every year. But as soon as I started putting money in this index fund, it was like that money was making more money, and I literally did not have to do anything. All I had to do was go through the effort of making the account in the first place and making sure I put money into it every month or every year. So that was Charles Stanley Direct. But then a few years ago, Vanguard decided to open up their investment portfolio platform to investors in the UK. Now, Vanguard is probably the biggest, most reputable company around index funds. And so when they made a UK branch that was open to retail investors in the UK, I was like, all right, cool, let's open an account with Vanguard. And so I've got two accounts with Vanguard. I've got an ISA, which is, again, the tax-free wrapper type thing, and I've got a general account, which is a taxable investment account. So once you've maxed out the ISA and you're no longer allowed to have tax-free share investments in the UK, at that point you can put money into a general account where when you make money off of it and you get money out of it, you're liable to capital gains tax and a bunch of other stuff. Anyway, so far I've put in 3 years worth of money into the ISA. So I've put in 60,000, so 20,000 for the last 3 years. And its current value, the ISA, is 73,902. So by investing 60k over the last 3 years, I have made 13k on top of that, which is kind of nice. And in the general account, I've put in, I think, around about 55k, and its value is 74k right now. And so again, by putting 55,000 into this account and then just forgetting about it, like I never, ever log into this, and just I don't even look at my account, because it's one of those set it and forget it things. You just put money in and then you forget about it. And then it's like once a year, if I need to count if I need to count my money, I log into the account and be like, oh, this is cool. This money has just been making money passively. And so overall, in my Vanguard account, which is entirely the S&P 500, I've got £148,329, of which 33.8k came from just the gains of putting money into the index fund. And then a few months ago, I decided to dabble with trading individual stocks, because I came across this app called Free Trade, which is a UK app on how you can buy individual stocks, and Free Trade is pretty good. Let me show you what my Free Trade portfolio thingamajiggy looks like. And the really cool thing about Free Trade is that if you sign up to Free Trade, you get this special link. And if someone else signs up to Free Trade using your special link, then you both get a free stock. And so because I share my link in some of my videos and on Instagram occasionally, I have 8 free shares to claim. So let's see what free shares I've gotten. Oh, a free share of Fuel Cell, Clean Energy Fuels, Asia Pacific, Barrett, SMFG, never heard of it, S4 Capital, British Land, Auto Trader, I've heard of Auto Trader. And so that's like more friends, more free shares, go away. Anyway, I'll put my free share link in the video description. If you're in the UK and you sign up to Free Trade, we both get a free share, and then you can share your link with other people and get free shares. It's kind of cool. Anyway, in total, I've got £27,794 in individual stocks, which is up by 7.7k since I started investing way back whenever it was. I can't remember when I started. It was in December 2020. So I've been investing in individual stocks in Free Trade for about 8 months at this point. If you want to have a quick look at my investments, so we've got Tesla, Shopify, MP Materials, the NASDAQ 100, Netflix, Teladoc, Fastly, Fiverr, Etsy, MongoDB, Collectis, bloody hell, that's lost a lot of money, Proto Capital. And then the rest of them are all the free shares that I've gotten over the years from like just people signing up to my thing. Oh, I got a free share of Apple at one point. That was kind of cool. Apple's gone up by 10%. Yeah, so just a bunch of this random stuff that you just get when you get random free shares through Free Trade. Like, I didn't actually, set out to invest in all of these individual stocks, but hey, I've got a lot of them kind of sitting around. The problem with this individual stock thing is that I have actually lost money on my investments since I started investing in individual stocks. The only reason I've gained money is because of this free share thing. Like, Shopify's gone up 35%, MP Materials, but like I've actually lost a bunch of money. Like Teladoc, I put in £2,000 into Teladoc, and it's now worth 1,300. Like, it's lost 34%. Fastly, I put in 2K, it's now worth 1.2K. It's insane. Collectus, I put in 1,000, it's now worth 400, so I've lost 58% on that. Basically, all of these books, all of these financial advice books will say that don't bother investing in individual stocks because you're competing against institutional investors who like have their big ass computers and whose full-time job it is to invest in individual stocks. And as a retail investor, as a random dude on the street like I am, there's no way I can feasibly beat the market. There's no way I can actually compete against these sorts of people without insider knowledge, which insider trading, it's kind of illegal. And so everyone says, and Warren Buffett says this as well, that just invest in index funds. You know, if you invest in all of the top 500 companies in the US, chances are then your investment gains are going to go up as the market goes up. But it's genuinely very hard to beat the market. And I was thinking, you know what? Let me find some stock picks on like the Motley Fool, and let me, you know, I'm going to invest in Tesla because I believe in Tesla. I'm going to invest in like Apple because I believe in Apple, etc., etc. And I've actually lost money. Whereas I've never lost money investing in index funds because it just tracks the market and the market always goes up. And so since this has happened, I kind of view dabbling with individual stocks as being more like a fun thing to do on the side. And I'm quite happy to put aside let's say 10% of my stocks portfolio to just dabble with individual stocks. But I fully expect that there's no way I'm going to beat the market. I'm probably going to lose money, but it's kind of fun. And so 90% of all of my stocks and shares are in the S&P 500 index fund, and 10% I dabble with on free trade. And to be honest, I make most of the money from free trade just through the free shares link. So yeah, free share link in the video description if you want to check it out. A few lessons about what I've learned investing in stocks. So number one, I really should have started earlier. I actually started making money in like 2013, 2014 with my business that was successful, but it took me 2 years of having money sitting in my bank account doing nothing for me to think I should probably invest this money. Like I did have that thought process earlier on in like 2013 and 14 as well, but something stopped me from thinking about investing because in my head it was like, oh, this feels really hard, I don't know how to get started, it feels really risky, I don't want to lose my money. All of these like stupid thoughts were floating around in my mind, and that meant that I actually started investing 2 years later than I could have done. And so I sort of wish I'd started earlier. Secondly, I've realized over the last 6 years of investing that you cannot time the market, and therefore don't bother trying. And there's a really nice phrase, time in the market is more important than timing the market. And I know so many people who wanted to get started with investing and investing in an index fund, but they were like, oh, the S&P 500 is currently at an all-time high. I'm just gonna wait a few weeks for it to go down, and then I'll put money in when the market goes down. And what these people are doing is trying to time the market. Like no one can time the market, it's literally impossible. And therefore the advice, which is not advice, is just put money in and forget about it for 10 years and the market will just always go up over time. Again, more details about that in my video up there. The market will just go up over time, and trying to time the market is always a fool's errand. In fact, one of my mates, who will be unnamed, like about 18 months ago when we first kind of got talking, I was saying to him, hey, have you considered starting an investment account? And he was like, oh, you know, I've been thinking about it. Maybe I will, maybe I won't. Never bothered signing up for the account. Maybe he signed up for the account, never put money in it. He would have literally doubled his money. No, he wouldn't have doubled his money. He would have had like a 60% gain in the last 18 months if he just, I don't know, signed up for the account there and then. It takes about 30 seconds on Vanguard or something, and actually just put the first bit of money into it. Because often when it comes to investing, just putting that first $100 or $1,000 is the hardest part. And then you do it and you realize, oh, this is actually not so bad. And it becomes very easy to then top up your investments over time. Let's say, I don't know, you get money from a birthday, or you do an extra shift at work and you've got the spare cash lying around. It becomes so much easier to say, hey, you know what, let me do something sensible and put 20% of it in my stocks portfolio. Because at that point, you know what it's like, you know how easy it is, you know you can do it with a few taps on the app. And so, I don't know, if you're in that position watching this video where you've been thinking about getting started with investing, just haven't really gotten around to it, then now, you know, the best time to start investing was 10 years ago, but the second best time is right now. So in total, we've got £300,990-ish in stocks and shares, mostly in the S&P 500, but a little bit dabbling in individual stocks like Tesla and Shopify and a little bit of Apple. Let's now move on to the crypto aspect of my portfolio. Again, I've got a whole video linked over there and in the video description about how I lost $56,000 trading Bitcoin. I started investing in Bitcoin in around about 2017 when the market was going up, and then the market crashed and I lost a load of money. And then crucially, I had to take money out. I had to sell and realize those losses so that I could afford the deposit on this flat that I'm currently living in. And so my crypto portfolio was looking very, very in the red. It was like minus $60,000 for the last 4 years. But crypto has recently done a rally. And so here is a screenshot of my portfolio on CoinTracker, which is a website that aggregates a bunch of different crypto wallets. And at the moment, the portfolio valuation is £92,903, which is a 7.8% increase. So I've made £6,700 from crypto over the last 4 years. this is like, this is great because you can see from this graph here, I was so in the red for such a long time where I had put in like 90K into, or like 60K into crypto, and it was worth like 12K. So that was quite demoralizing for a long time. But now, again, with crypto, I've decided I'm just going to set it and forget it. So I just have a weekly order where I buy some Bitcoin, buy some Ethereum, and buy some Cardano of all things. And it just sort of takes money out of my account, and I've kind of forgotten that it's there, which means over time, hopefully I'm doing the thing of dollar cost averaging, buying crypto a little bit at a time with no intention of selling it for a very, very long time, trying to hold on to those diamond hands. And if you're interested in the portfolio allocation, I've got about 50K in Ethereum, 34K in Bitcoin, 4K in Litecoin, not doing very well, 3K in Cardano, not doing very well at all, and 500 quid in Dogecoin, which has lost 50% of its value since I started investing in it. So Ethereum has been good to me. Ethereum has been pretty good because the thing I didn't sell back in 2017 was Ethereum. So I had some Ethereum from way back then, which has kind of gone up in value over time. Let's talk about what I've learned investing in crypto. Again, all of much more details in that video about how I lost $55,000 and the lessons I've learned from it. But the most important things are like, number one, what I've learned from it is don't try and day trade. It's a terrible idea. If you want to get involved in crypto, then just buy and hold because you can't beat the market when it comes to day trading. Secondly, I really view crypto as being gambling. As like it's pure 100% gambling. It's not an investment. It's actually just me gambling with my money. And so I'd make sure that I'm not putting any money into crypto that I might need in the next like 5 years. And lesson number 3 for investing in crypto is, and general investments, is don't get emotional. Like a big part of why I put in so much money in 2017 was because I was like, that fear of missing out. The crypto was going to the moon and I wanted to get in on it. And then like when it crashed, it was just stupid. Like all of my decisions around crypto in 2017 were 100% emotional. These days, I treat it like more of a rational investor. There's this newsletter that I subscribe to called Crypto is Easy. The guy there has a plan. He's done the numbers. I just follow his plan and I just kind of do what he tells me to do. So if you want to check out Crypto is Easy, not an affiliate link, not sponsored or anything, but that's the newsletter that I use for my crypto plan personally. So we've talked about stocks and shares and we've talked about crypto, and so the total value is around about 390K or something like that at the moment. Let's now talk about real estate. So the thing with real estate is that it takes a very long time to get started. And so up until about 6 months ago, the only real estate I owned was this flat, which has a mortgage on it, which is a joint mortgage that I have between me and my brother. We got this mortgage in 2018. And so the purchase price of the house was £370,000. We put in a £55,000 deposit. And so far, I've paid back around 30K of the mortgage. And so there's around about £85,000 of equity tied up in this house, but it's got a mortgage on it. And I usually have a lodger living with me, and I've got my cousin living with me kind of further down the line, and so on and so on. But I don't really consider this to be much of an investment. I mean, I think the 85K that's in the house is a reasonable investment, and the fact that I've been living with a lodger means that on the rent that I'm saving from living in this house and the fact that I've got a lodger living with me who's paying me rent, I get around about a 16% return every year, which is pretty solid. Like that's not bad at all. And so I really only consider the 85K of equity that I've got in the house as being an investment. The rest of it, it's all part of the mortgage anyway, and the value of the house hasn't really increased very much in the last 3 years. And so, yeah, let's call it 85K in real estate. But quite excitingly, I'm in the process of buying another 3 flats to use as rental properties. The amount of paperwork it takes to get this sort of stuff sorted is an absolute nightmare, so we're still going through the paperwork for all 3 of those. But that's because since this YouTube channel and the business around it has been making decent amounts of money, mostly over the last year and a half, I've now kind of started putting some of that money into real estate. So I'll make a video about it when it's all kind of sorted, but right now we're just in the paperwork stage of trying to figure out how to get buy-to-let mortgages under a limited company, and there's all this sort of really complicated stuff in the UK around how to actually invest in real estate in terms of rental properties. And so if we take the 85 equity that we've got in the house, that takes our total up to something like 470K or something like that. There'll be the actual calculator on the site, which actually has the numbers because I can't do quick maths. Let's now talk about angel investments. Now, what is an angel investment? An angel investment is when an individual, I don't know why it's called angel, it's a bit self-aggrandizing. But basically when an individual investor invests in early stage startups. So through this YouTube channel, I've actually gotten emails from people who are starting companies and are looking for investment and want me to invest in their companies. And especially if it's products that I already use and I already like, I speak to the founders and they seem cool and they send me their pitch deck and I'm like, oh, cool. I'll invest a little bit of money in this company. I can't tell you how much I've invested in the companies. It's not that much. But so far I've invested in 4 companies. I'll put links to all of them in the video description. The first one is Riverside.fm. I've been using Riverside for the last year to record my podcast. And so I reached out to the guys, we got talking, and I invested in the company. So they're great. A video about Riverside coming at some point soon. Check it out, link in the video description. Secondly, a company called Peak. This is a company based in the UK. It's fairly new. They're trying to make reading a more social experience. And so they, I think, reached out to me initially. And then we got talking, and they're really cool. So I invested in them. And I'll be using their product extensively as it improves and once it goes out of beta. Thirdly, we have StudyStream, which is like this live co-working-y type group where I've dabbled with a few StudyStream sessions, but it seems like a really great model, and so I invested in them. And fourthly, one that's fairly recent, investing in a company called Heights, which is like a brain care supplement thing that I've been kind of dabbling with, and became mates with like the founder the other day and decided to invest in the company. And so I'm fairly new to this whole like angel investment thing. I know a lot of YouTubers do it. I know like Casey Neistat, Marquez Brownlee, MKBHD, these guys are all like big angel investors, which they don't really talk about on their YouTube channels. I guess I don't know. Are there rules against it? I don't think there are rules against it. Usually people are pretty public about that sort of stuff. But yeah, it's a new area that I'm dabbling in. And so if anyone has any advice, reach out to me on Twitter. Like I'd love to speak to people who actually do angel investments because I don't really know what I'm doing. I'm just trying to invest in companies that I think are cool and trying to do my best to add value to them, either as an advisor or as like promoting their stuff on my YouTube channel or whatever. Next, we have the asset class of cash. Cash is an asset class. I know Graham Stephan talks about how he always has like $1 million plus like of cash just sitting in the bank account, waiting for him to pounce on some kind of real estate deal. I'm nowhere near as sophisticated as that. I don't really like the whole real estate thing because it's slow and annoying. And I basically carry 0 cash. In fact, I hit my overdraft the other day because I just never have any cash in my current account because any cash I do have is either in the business account or it's in investments. And so I keep very, very little cash on my person at any given moment. And to be honest, my expenses aren't really that big. Any tech that I buy for the business is a business expense. And the only thing I really spend money on is like these Ralph Lauren shirts recently and like takeaway. And so my salary through the business kind of helps with that. But what's kind of interesting is that because of the success of the kind of the magical internet YouTube money machine, we've got actually a bunch of cash sitting in the company account doing absolutely nothing right now. And so I was speaking to Ben Francis, the founder of Gymshark, the other day, interviewed him on my podcast, which is going to be launching soon. And I was talking to him about this thing, and he was kind of joking that we're hoarding cash in the business, and we've got to do something useful with that cash. And so right now, we're actually in the process of hiring around 8 or 10 people for the business. By the way, I'll put a link to our jobs page in the video description if you want to check it out. If you're interested in joining the team, if you're based in London, come work for us. It's kind of fun. And we're just trying to figure out better uses for that cash, which is currently just sitting in the bank account, depreciating via inflation every year. Now, the final asset class that I want to talk about is digital assets. Now, most people wouldn't consider this to be a standard asset class. Like standard asset classes are stocks and real estate and crypto these days. But actually, if we think of like, what is an investment? An investment is something that you put money into initially and it makes money for you, which stocks do, which real estate does. But actually, digital assets do that as well. And so what's an example of a digital asset? An example of a digital asset is, for example, a YouTube video. So when you make a YouTube video and it's out there on the internet, people can watch that video while you're sleeping, and you make money through AdSense on that YouTube video. And so in fact, let's have a look at our YouTube analytics. Let's look at the last 90 days. So the AdSense on this channel has generated, in the last 90 days alone, $121,903. Just in the last 90 days. That is absolutely absurd. And if we look at where that money is coming from, last 90 days, okay, this is a passive income video, which has made $47,559. That's insane. That video came out in April. So I put the work into making that video back in April, and then my team edited it very nicely. But that video is its own digital asset in that it's like an investment. It's been putting money in our pocket every day since then, because every day people are watching this video, and therefore it's making money on AdSense. The Ultimate Guide to Investing in Stocks. I made that video in October 2020. So for the last year, that video has been as an asset class, making passive income, and that's made $4,800 in the last 90 days. 8 Habits That Made Me a Millionaire. Bit of a clickbait title, apologies. But I made that in June, a couple of months ago. In the last 90 days, it's made $3,000. How to Build a Website, $2,000. How I Type Fast, $2,000. How I Manage My Time. Writing Online. Answering uncomfortable questions for my personal assistant has made $1,600 in the last 90 days. $1,500, $1,200. And so, like, YouTube videos are an asset class, and most people don't think of them as such, but like, if an investment is something that puts money in your pocket, then anytime you make a YouTube video, you are investing in yourself. You're putting a digital asset out there online, which, if it's evergreen content, could be making you money for a very long time. And so, in fact, there are still a bunch of videos on here which I made like 2 or 3 years ago that are still making money. And the amount of return you can get on this, like, obviously, now that the YouTube channel is quite big, this is much higher than it was. But it just goes to show that if one video can make a few $1,000s a month, and like, you know, if you're really lucky, a good real estate property will make a few $1,000s in a year, then the sort of treating digital assets as their own asset class makes a lot of sense. And equally, there's online courses as well. I'm not going to show you the online courses portfolio, but we've got a bunch of classes on Skillshare. Are they sponsoring this video? No, they're not, but I'll put some links in the video description if you want to check them out. Bunch of classes on Skillshare. I put the work into making the class once. And so, for example, if we use I have an online class on Skillshare about how to edit videos with Final Cut Pro. I made that class in September 2019, so 2 years ago. And every single month since then, it's been making somewhere between $2,000 and $5,000 per month in pure passive income without really any promotion on my part. That is absolutely insane. That's a class that took me 1 day to film and took a freelancer 2 days to edit, and it's been making somewhere between 2 and 5K every single month without me having to do anything. It's just completely absurd. And you just don't get those sorts of returns with the normal asset classes like stocks and shares and real estate. Maybe you get them in crypto, but it's a lot less consistent than that. And so generally, when I think about investments, I think there's like the traditional stuff, like real estate, stocks and shares, crypto. And then there's the non-traditional stuff. There's the stuff where it's almost like playing a game, right? Where if you're kind of a level 1 character, if you're like the default character, the only real thing you can invest in is stocks and shares, because you can get started with like $10, $100. As you level up and as you get more money, you can then you unlock the category of real estate. Because to invest in real estate, you actually need a decent amount of money to start up, because you need the deposit on the house, which is usually 25% of the value of the house, at least it is in the UK. But I think there's like an extra level here, whereby if you're a creator and you have an audience on the internet, that unlocks the asset class of online courses and YouTube videos and ebooks and digital downloads and even physical products. My friend Olier has a physical product store where, again, that is an asset class. He's building a business. A business is an asset. A business is an investment. And so overall, if we exclude all the digital stuff, maybe there's just 500K-ish in my investment portfolio. It's nowhere near as fancy as some other big YouTubers are. But I've made a bunch of mistakes investing over the years, and hopefully that will increase over time. But really, when I think about investing, I do think more about the digital asset classes than I do about things like real estate and stocks. I view real estate and stocks as being kind of like if all else fails, and if YouTube crashes, and if I get cancelled and my internet career is gone, at least the stocks and the real estate thing will still be there. But really, I think most of the gains are to be had in the digital realm. So that's it. Hopefully you found this video interesting. If you're interested in getting started investing in stocks and shares, you should definitely check out this video over here, which is my ultimate guide on investing in stocks. Loads of people have seen that, and we've gotten emails from people like, oh my God, thank you so much. This video changed my life. I've started investing and I'm an investor now. So thanks so much for watching. Do hit the subscribe button if you aren't already, and I'll see you in the next video. Bye-bye.
It's a great day to help people customize and save with Liberty Mutual. Whoa.
Hey friends, welcome back to the channel. In this video, we're going to talk about 9 different ways that you can make passive income. And for each of those, I'm going to talk about how hard it is to get started, how hard it is to make $100 a month from it, and how hard it is to maintain once you've created the thing in the first place. For me and my business, these 9 different sources generate around $27,000 per week these days with varying degrees of passiveness. And obviously this has taken me like 8 years to build up, so don't expect to be hitting those sorts of numbers when you first get started. But this is the video that I wish I would have had when I started my financial independence journey many, many years ago. Let's go for it. All right, so when I say passive income, I always air quote it because there is really no such thing as passive income. There is no way to make money without doing anything at all. But when I say passive income, what I mean is that it's money that is not directly tied to our time. So let's say you were to write a book. If you write a book, you publish a book, that book is now on bookshelves. You've done the work kind of once to write and publish the book, but now anytime the book sells, you make money from royalties. That is passive income. You could literally be making money while you sleep because you've created this thing which is out in the world, which is generating income for you. The other thing with passive income is that it always takes a very long time to get going. So If you see any ads before this video talking about how you can get rich quick by whatever scheme, or if you see people in the comments pretending to be me saying, oh my god, here's how you can get rich quick with crypto, WhatsApp this number, that is all a scam. It's not going to work. There is no way to get rich quick. It is not a thing. So if you're looking for a get rich quick scheme, those things just don't exist. So you might as well not even try. And the way I think of this is that ultimately money is just a medium for exchanging value. The only way to make money is to provide value. And the only way to make passive income, passive money, is to provide value in a way that is not directly tied to your time. So please, please, please do not try and join a get rich quick scheme. They don't exist. I've had lots of messages over the years from people who have tried signing up to a get rich quick crypto scheme or a gambling scheme or a, hey, here is how you kind of play poker online. None of these things ever work. People always end up losing money. The only way to make money is by providing value. And so let's talk about the 9 different ways that you could provide value if you wanted to. Just before we dive in, I want to tell you that I've just launched my brand new Skillshare class about productivity for creators, how to start a successful side hustle. That's linked in the video description. Skillshare is sponsoring this video. I'll tell you more about Skillshare later on, but I want to plug my own class because I think it's genuinely really good and people really like it, and it will help you get tips on how you can start side hustles in your spare time. Anyway, let's get into the video. All right, so let's kick things off with investing in stocks and shares. And in this context, the way that we provide value is by offering up our money. Providing money and investing in a service is, in a way, giving a form of value. And so when we give our money to a company in the form of buying their stocks, it makes sense that we would get some kind of return for that investment. And we're starting with this because investing in stocks is the easiest way to make any kind of passive income. If you have any sorts of savings and they're sitting in a savings account earning 0.01% interest, they're not really doing very much for you. Whereas if you had those savings and put them in stocks, you could potentially be earning passive income from the money that's otherwise just sitting there. Now, I've got a whole video called The Ultimate Guide to Investing in Stocks and Shares for Beginners, which is going to be linked over there somewhere. So that is a solid half an hour long introduction to stocks and exactly how they work. But the thing that I recommend for most beginners as a non-financial advisor, and this is not financial advice, purely for entertainment purposes only, or so people say, or at least the thing that I do, is that basically all my money that's in stocks and shares is invested in index funds. Now, an index fund is something like the S&P 500. And when you invest, let's say $1,000 in the S&P 500, that basically means that your $1,000 is distributed amongst the top 500 biggest companies in the US. So, you know, weighted by how big they are. So like, 2% of it would be in Apple, 2% in Facebook, 2% in Google, 2% in Microsoft. And then you probably won't have heard of the 500th company on the list, but basically all the big US companies you've heard of, you end up investing in all of them a little bit at a time. So if you want to get started with that, all you need to do is sign up to a stockbroker. If you're in the US, you can use Webull, I think. I've got a link in the description. If you're in the UK, you can use Freetrade or Vanguard. Basically, whatever country you're in, just Google the phrase best stockbroker platform, your country name, and you'll find something that works for you, and then it's very easy to be able to invest in an index fund. So within our famous side hustle assessment matrix, we're going to give the difficulty of starting a 1-star rating, 1 out of 5. It's very, very easy to get started with stocks. How hard is it to make $100 a month by investing in stocks and shares? Well, this kind of depends because it depends on the performance of the stock market overall. So in the last 12 months, from 2020 to 2021, the S&P 500 has actually increased by about 50%. That is a lot. It's like gone up by a solid 50% despite COVID and everything going on. So if in April 2020 you had invested $2,400 in the S&P 500, the fact that it's gone up by 50% means you would have made $100 a month. But obviously this is not the way to look at it because, things can go up and down, and the stock market has different levels of performance depending on what time period you're looking at. But if we average out the last 30 to 50 years, the S&P 500 has had a roughly 10-point-something% return, which means every year, on average, over the long term, it goes up by around 10%. This is not inflation adjusted for any economist among us. And so if we do some back of the envelope calculations, if we want to earn $100 a month passively through stocks and shares, we would need around about $12,000 invested in the S&P 500 to make that 10%, $1,200 a year, which is $100 a month. But as I talk about in that video about stocks, over time we have compounding, and so if you put in $7,500 in the S&P 500 and you left it there for 5 years, then 5 years later you would be making roughly $100 a month if we go by this very average figure of 10% a year. Or if you invested $5,000 in the S&P 500, then 10 years later you'd be making $100 a month in purely passive income, again assuming the 10% average. So overall, how hard is it really to make $100 a month in passive income from stocks and shares? Well, it kind of just depends on how hard is it for you to make $5,000, $7,500 or $12,000 in savings and put them into a stock market index fund. And crucially, this is money that you shouldn't need to touch in the next 5 to 10 years at least. So basically, how easy is it for you to make that sort of money? Obviously varies massively depending on which country you're in and what your circumstances are and what your job is. But if you're in the UK or the US, where the median kind of average salary is around about $50,000, something like that, then again, depending on your circumstances, it's not that hard to get $10,000 in savings. Obviously, if you're supporting a family of 15 people on $50,000, it's different. If you're a single person, again, it's different. But I'm going to give this roughly a 3 out of 5 star rating for difficulty of getting $100 a month. Obviously, if you live in a country like India, where the average salary is $3,600 a year, it's very, very difficult to make $10,000 in savings overall. And finally, the third category in our side hustle assessment matrix is how hard is it to maintain this income once you've set it up in the first place. And we're going to give this a 1 star out of 5 because once you've got the money in, you just like set it and forget it, and it's not that hard to maintain. There are other sources of passive income that require higher degrees of maintenance over time, but stocks and shares is a very, very easy way to make passive income. And to use my personal example, these days my stocks and shares portfolio, which I've been investing in since 2015, is now worth around about $350,000, and the vast majority of that is in the S&P 500 index fund. Now, I can't be bothered to work out the actual inflation-adjusted returns for that, but again, if we assume a very, very rough average of 10% a year, then that averages out to around $682 per week in purely passive income. All right, idea number 2 for generating passive income is to start a YouTube channel. This is something I will specialize in because I'm here on YouTube, and I actually teach a course called the Part-Time YouTuber Academy, linked in the video description, where I teach people how to do this sort of thing. So let's use our side hustle assessment matrix and we'll talk about this. How hard is it to start a YouTube channel? Well, I'm going to give this 1 out of 5 stars because it's actually very, very easy to start a YouTube channel. You just go on youtube.com, you click create a channel, and you can upload videos by just filming with your phone and uploading it. In reality, it's a lot harder to make good videos, and making good videos is how you grow on YouTube. But getting started on YouTube is very, very, very straightforward. The real question is, how hard is it to actually make real money from YouTube? So again, let's say we want to make $100 a month in passive income. What does that look like? Well, firstly, to be eligible for monetization on YouTube, you need 1,000 subscribers and 4,000 hours of watch time. It took me 6 months and 52 videos to get my first 1,000 subscribers. And if we look at the averages, it actually takes on average 90 something videos to get to 1,000 subscribers. So that's quite hard. If you're thinking you're going to start a YouTube channel and start making money from day one, that's basically not going to happen. It took me 52 videos, 6 months to get there. So if people message me and be like, hey, I want to start a YouTube channel, I was like, look, you have to be able to put in the effort and do this for a very long period of time, at least once a week, I say for at least 2 years before you can expect anything in return. But let's say you've hit your 1,000 subscribers and your 4,000 hours of watch time. How hard is it to actually make $100 a month? Well, on average, the kind of revenue per 1,000 views on YouTube is around about $2. So this varies massively, but let's say on average about $2 per 1,000 views. Therefore, if you want to make $100 a month, you need 50,000 views on YouTube to make $100 a month. Let's say you make 1 video per week, and let's assume you're not getting any traffic on your older videos. That means every video you make needs to get around about 12,500 views. And very roughly, the average YouTube channel can expect around about 20% of their subscribers to equal the average view count for each video. So on YouTube, if you had 62,000 subscribers, very roughly, very averagely, you can expect 20% of them, i.e. 12,500 views on each video, and assuming you have no evergreen content over the long term, you would need around about 60,000 subscribers to be making $100 a month. In reality, you make $100 a month a lot before 60,000 subscribers. I think I was making $100 a month when I had like 10,000 something subscribers. Like it was fairly early on. But when it comes to assessing how hard is this to do, I'm going to give this a 4 out of 5 stars. It's actually very hard to make compelling YouTube videos, and it's very easy to get started, but it's hard to do well. It's totally worth it. It's a great skill set. It's really fun. You get to meet people across the internet. You get to learn how to talk to a camera and how to film and video edit, and it's really great. But it's very hard to actually make money from YouTube. Finally, in terms of effort to maintain, like actually getting that first 1,000 subscribers is a lot harder than keeping it growing. Because once you've got 1,000 subscribers and once your channel is growing, it means you've landed on a formula that works. And so maintaining it then becomes easier than starting from scratch. And so in our side hustle assessment matrix, we're going to give maintenance of a YouTube channel passive income stream to be around about 2 out of 5 stars. To use my example, I made 70 videos before I started making any money from YouTube AdSense. And these days, the YouTube channel makes around about $12,000 a month in passive income from YouTube AdSense. Now, again, this is not entirely passive because I keep on uploading new videos, but actually the bulk of the amount of money that we generate from ads is from older videos rather than videos that were uploaded this month. So with that caveat, $12,000 a month passive income is around about $3,000 a week thanks to this YouTube channel, and thanks to you guys for supporting it and all that stuff. There are other ways of monetizing YouTube, like brand deals and like selling merch and this all other sort of stuff, but it doesn't really count as passive income through YouTube, which is why I'm not including this in this side hustle assessment matrix. metrics. Idea number 3 for making passive income is to start a podcast. This is generally easier than starting a YouTube channel, although growing a podcast is a lot harder than growing a YouTube channel because podcasts themselves don't really have a algorithm that's helping them grow. In fact, a lot of podcasts grow by having a YouTube channel, which is kind of weird. Right, so how hard is it to start a podcast? Well, again, 1 out of 5 stars. It's very, very easy to start a podcast. Go on anchor.fm and you can literally use your phone and you can pass your phone around between you and your friends and you can start a podcast. You can use a website called riverside.fm that I've recently invested in as an angel investor. Riverside makes it very easy to record remote podcast interviews. It's very, very easy to start a podcast. But how hard is it to make $100 a month in passive income from a podcast? Well, again, this is not quite passive income because the way podcasters make money is by relying on brand deals. There is no YouTube AdSense for podcasts. And so you need a sponsorship or a brand deal to make any money through your podcast, generally speaking. And apparently you can expect to make around $18 for a 30-second ad in a podcast and $25 per 1,000 views or 1,000 listens for a 60-second ad. So if you want to make $100 a month, and assuming you have a stream of sponsorships who are giving you that level of sponsorship deal based on your download numbers, you would need around 1,000 downloads per episode if you have a weekly podcast. So you would have 4,000 downloads a month. And if you're putting a 60-second ad in there for $25 per 1,000 views, that would make you around about $100 a month by having 1,000 downloads per episode and 4 episodes per month. This begs the question, how hard is it to get 1,000 downloads per month? Well, it's a lot harder to get 1,000 podcast downloads per month than it is to get 1,000 YouTube views per month because, again, YouTube has so much distribution built in. It's different to podcasts. Also, loads more people are on YouTube than on podcasts. But if we look at the stats, then it's the top 20% of podcasts in the world that get, on average, more than 1,000 downloads per episode. To use a friend of mine as an example, my housemate Sheen started her own podcast around 5 months ago. There will be a link to that in the description if you want to check it out. And on average, her podcast gets round about 400 to 500 downloads per episode. This is not bad at all, especially considering she started 5 months ago and had 0 audience when she started, so she didn't have the unfair advantage that I did when starting my own podcast, for example. And because she's just launched season 2 of her podcast and has just started posting videos about it on YouTube, that will really help the podcast grow. And I'm pretty sure that in the next 6 months, she'll be getting to a point where she can quite easily make $100 a month from her podcast. So going back to our side hustle assessment matrix, starting a podcast, 1 out of 5 stars. Making $100 a month, I'm going to give that a 3 out of 5 stars because it's hard, but not as hard as maybe monetizing on YouTube where you have this minimum threshold. And finally, maintenance, well, it's not really passive income because you do have to keep on making podcast episodes because the brand deals are associated with that. But again, once you've stumbled on a formula that works, once you know how to be a podcaster, it's easier to continue going once you've already gotten started, as is the case with most things. And so in terms of maintenance of the podcast, I'm going to give that 2 stars. To use me as an example, so me and my brother have a podcast called Not Overthinking, link in the video description if you want to check it out. But we make around about $625 per week from the podcast overall, from brand deals and from our membership. All right, so idea number 4 for generating passive income is to become an affiliate marketer. Affiliate marketing means that you are selling other people's products, but you're getting a percentage of the sales from those products. Now, apparently, 48% of affiliate marketers globally earn $20,000 a year, which is $1,660 a month, which is actually not bad at all. Like, people are doing very well with affiliate marketing overall. So how hard is it to get started with affiliate marketing? Well, I'm going to give this a 2 out of 5 stars. Basically, you can just sign up to an affiliate program like Amazon Associates. So Amazon have their own affiliate program, which I think is probably the biggest in the world. And then once you have your little special links, you can post those on your website or on Twitter or on social media or whatever. And if people buy the product through your link, or in fact buy any product on Amazon through your link, you'll get like some tiny percentage of the sales. So pretty easy to get started with affiliate marketing, but how hard is it to make $100 a month? Well, this is actually kind of hard. So let's say you had a product that was $50 that you were trying to sell and you were getting 5% commission on it. That would be pretty good. Amazon doesn't offer nearly as much as 5%. It offers like 2 or 3%, something like that. And let's say your average conversion rate, i.e. people visiting the thing, versus people actually buying the product after visiting the thing. Let's say that's 1%, which is pretty reasonable for a conversion rate. You would need 8,000 visits to your website or whatever to make $100 a month. It's actually quite hard to get 8,000 visits per month to your website, to a specific product page, and generally doing well in affiliate marketing requires lots of upfront effort in terms of either building an audience or building such domain authority in whatever space you're in that you're sort of organically getting traffic. Now, other than Amazon, there are a few other affiliate programs that I'm part of. One of them is Skillshare, who are kindly sponsoring this video. I'll tell you about the sponsors segment later, but Skillshare have an interesting affiliate program where if you refer someone to sign up to a free trial of Skillshare, you can get $7 in affiliate commission just for that thing. So if you wanted to make $100 a month from affiliates, you would need 15 people every month to sign up for Skillshare with your affiliate link thing. How hard is it to get 15 people a month to sign up with your affiliate link? Well, it's not that hard if you have an audience, and it's not that hard if you have your own classes on Skillshare like I do. I have like 9 of them. And so if I want to make money through Skillshare affiliates, I can just tell people, hey guys, I can tell you that, guys, I've just released my latest Skillshare class, Productivity for Creators, How to Start a Successful Side Hustle. So there'll be a link in the video description if you want to check that out. Like, that would be, hopefully, some of you will see that. We'll click on that link in the description, and then that will be me getting some affiliate income from Skillshare for this video. So going back to our side hustle assessment matrix, how hard is it to make $100 a month? I'm going to give this a 3.5 star rating because, again, you need an audience. And as we always talk about on this channel, the way you build an audience is by creating useful content, putting it for free on the internet once a week, and doing this for at least 2 years. If you just follow those 3 steps, I guarantee you'll have an audience and you'll be able to make some kind of money through this passive income stuff. But that's quite hard to do. No one sticks to it for at least 2 years, so we'll give that a 3.5 star rating. But the good news is, once you've created it and once you've started making money from affiliates, it's actually quite easy to maintain, because especially if you have evergreen content, the sort that isn't relying on like current affairs or the latest news, the sort that people might search for over a long period of time, this becomes like relatively reasonable passive income. Now, if we look at me and my business, these days from Skillshare, we make around about $11,000 per month in affiliate income, which approximates to around $2,750 per week. And from Amazon, on average, like, it's around about $450 a month from the Amazon UK store, and a little bit more from the US and Canada. All right, method number 5 of making passive income is by selling digital products. Now, these are products that you create once, like an ebook or a download or an app or something like that. So you create it once and then you can sell it multiple times, because selling digital products doesn't usually have any cost associated with it. One really good example is this guy called Traff, who I follow on Twitter, who made an iOS 14 icon set and sold it for like $30 a pop a few months ago, and ended up making, I think, like $300,000 in the course of like a few weeks, just because loads of people around the world wanted to buy his icon pack. So he put the work into creating the pack, and now he's selling it for lots of money. Another example is my YouTuber friend Olier, who has made, as he says, $700,000 from selling his website Tumblr themes since 2014. So he made the website themes for Tumblr, he sells them, and he makes $700,000 on average, well, overall, since 2014. That's pretty cool. So how hard is it to get started making digital products? I mean, anyone can write an ebook. An ebook counts as a digital product. So I'm going to give this a 2-star rating, 2 out of 5 stars. But obviously, like, again, money is an exchange of value. So the thing that you're selling, you have to be providing enough value to compensate, to make up for the price that you're selling it for. And that's often quite hard, especially if you don't have any experience in this sort of field. And how hard is it to make $100 a month? Well, you know, it's very easy to create an ebook, but it's a whole different ballgame trying to get people to actually buy your ebook or buy your icon set or buy your app or buy your website themes. And because the market around this stuff is so competitive, like, you have to be genuinely really good to get people to buy your stuff. And the way you get people to pay you money for something is that you identify a problem that they have, you solve that problem, and then you charge money for it. And if you can do those 3 things, then it's, you know, I wouldn't say it's easy to make $100 a month, but it's very doable to make $100 a month. You just genuinely have to have something that solves a pain point that other people are willing to pay for. So we're going to give this a 3 out of 5 stars to make $100 a month from selling digital products. And finally, in terms of maintenance, we're going to give this a 2 out of 5 stars, because usually you do have to maintain your product a little bit, but it's often easier to do. Like, it's much easier to maintain a product than creating a product in the first place. Idea number 6 for passive income generation is to create an online course. Now, online course is sort of like a digital product, but generally online courses are in video format. In fact, this whole video is so long, it could basically have been an entire online course. Maybe I'll do one about this very topic. And in terms of getting started, we're going to give the starting difficulty a 2 out of 5 stars. Because it's not that hard to make an online course, but generally you do need to know how to do video. So, you know, you actually could film an online course on your iPhone or phone, whatever phone you're using. If you're one of those Android heathens, stick your phone on the side, talk to the phone, teach something. So it's not hard creating one. But in terms of making $100 a month, again, at that point, your course needs to actually be good. And the only reason people will pay for it is if the course is actually good. Now, you can avoid having to charge for your online courses by using a website like Skillshare, who are very kindly sponsoring this video. I have tons of classes on Skillshare. I think we've got 9 on them in total. I've been teaching on Skillshare since September 2019, and I've actually just released my new online class called Productivity for Creators, How to Start a Successful Side Hustle, where I teach you the ins and outs on how you can, well, create your own side hustle in your spare time without quitting your job. If you want to check this out, then the first 1,000 people to click the link in the video description will get 30% off the annual Skillshare premium membership. This is actually a really really good deal. I pay for Skillshare. I have been paying for it for years, even after I started teaching on it, because it's genuinely a fantastic place to learn stuff. They've got thousands of classes on all sorts of other topics, but you should definitely check out mine, like the 9 that I've got. There are 3 around productivity now, like the fundamentals of productivity, the sort of productivity equation, which is how I think of productivity, and productivity for creators. I have 2 on how you can study for exams. If you're in school, if you've got exams to prepare for, those apparently are really good. They've got very high ratings. And if you've already had a free trial of Skillshare, then you can still use that offer, that if you're one of the first 1,000 people to hit the link in the video description, you will get 30% off the premium membership, and you can check out my class, which I have to say is pretty good. Anyway, thank you Skillshare for sponsoring this video, but genuinely, Skillshare is a great place to teach stuff because you can teach things on Skillshare without directly having to charge for them, which is why I love putting my courses on Skillshare. It's kind of like having something on Netflix in that the end user does not have to pay directly for the product. And the other nice thing about Skillshare is that it's like it's sort of like YouTube in that anyone can upload a class to Skillshare provided it meets certain quality requirements. And so it's a lot easier than having to make your own website and create your own courses platform and all that kind of stuff. So pretty easy to start. We're going to give this a 2 out of 5, but how hard is it to make $100 a month from teaching online courses? Now this kind of depends. If you're going down the Skillshare route, then to make $100 a month on Skillshare, you need around about 1,700 minutes of watch time, which is 28 hours of watch time. So if you have a 1-hour class on Skillshare, you need 28 students to take that class every month and watch it with a premium membership, roughly, very broadly speaking, and that will give you around about $100 a month. At least those are based on my figures over the last 2 years of being on Skillshare. Now, how hard is it to get 28 people a month watching your class? Well, if your class is actually pretty good, it shouldn't be too hard to get 28 people a month watching it. If you have an existing audience, it's very easy to get 28 people a month watching it because people already know, like, and trust you, hopefully, and so they'll watch your stuff and give you a shot because you've already built that goodwill with them. But the nice thing about Skillshare as a platform is that they have their own algorithm, so the good stuff rises to the top. So if you genuinely have a really good class and you put it on Skillshare, then even if you don't have an audience, there is still a high chance that if the class is actually good and people watch it a lot and people recommend it and give it high ratings, it will rise to the top and it will start getting recommended to people who find it on the Skillshare homepage or who search for it specifically. The other way of making $100 a month from a course is to just charge $100 for a course, and then if you do that, you just need 1 sale every month. So how hard is it to get 1 person a month to buy your course? Well, again, if it's good, the world of online education is exploding so much. Every year more and more money is being spent on online education, especially with the whole pandemic stuff. So if you have a valuable skill that you can teach, I think courses are one of the best and one of the best ways of making passive income, because it's fun to create a course, you can teach stuff, you don't need that many technical skills like making a website or anything like that. Just shove it on Skillshare and then people can take your course and learn on the internet, and it's just cool overall. And the nice thing is that once you've made the course and once you're making $100 a month from it, maintaining that level is actually quite easy. We're going to give that a 2 out of 5 stars because generally you don't need to update the course that often, and you can do that once in a while, and you just need to make sure you're getting a reasonable amount of traffic to it, and hopefully that traffic will grow over time. These days, the vast majority of my online courses, at least the very passive ones, are hosted on Skillshare, and it's kind of ridiculous, but these days they make around about $60,000 to $65,000 per month in purely passive income. I literally do nothing for my Skillshare classes once I've made them, other than reply to comments and other than occasionally plug them in videos, and that's $60,000 a month in passive income. That means this is around about $15,000 per week, and this makes up the bulk of the $27,000 a week that this business currently generates in purely passive income. Idea number 7 for passive income is by creating some kind of paid membership or community model. Now again, this is generally a bad idea unless you have an existing audience, which we keep coming back to. Everything becomes easier when you have an existing audience by creating content that has been valuable over a long period of time, very consistently. That audience knows, likes, and trusts you, and so when you say, hey guys, sign up to my Patreon, then some people are likely to do that thing. The other way of doing a membership is by creating a value proposition that is so compelling that people will be willing to pay for a community-like service for this. If we use Patreon as an example, my friend Hannah Witten, who's a YouTuber, she's got around about 600,000 subscribers on YouTube, and I think she has around 600 patrons, 626 last time I checked, which means if we look at her Patreon stats, which are public, she's making somewhere between £2,000 and £5,000, or $3,000 and $7,000 per month in passive income from this audience. But it's 600 people out of an audience of 600,000. So 1 in 1,000 of her subscribers have signed up to her Patreon. So clearly, if those stats are true across the board, and they kind of are if you look at Matt Diavella's Patreon as well, you need a big audience to make a significant amount of money from Patreon. Again, this sort of depends on how much you're charging for them and exactly what value you're providing. Another example of a paid membership community is my friend Anne Law, who runs a website called Nest Labs, and they have a paid membership community which is $5 a month. And she started this, when was it? In summer of 2019. She had 0 audience at the time. And she just wrote 100 blog posts over 100 working days and built up an audience such that in March 2020, when she launched a membership, she had some paying members for it initially. And I think last month, she's just passed $100,000 a year in annual recurring revenue, which is pretty awesome from something that started less than 2 years ago. So how easy is it to start a membership program? Well, it's actually very easy. We can give this a 1 star because it's very easy to start one. You just make an account on some kind of membership platform like Patreon. But to make $100 a month, you need to provide $100 a month worth of value. And that's actually quite hard to do. We're going to give that a 4 out of 5 stars. But the nice thing is, again, once you've got that formula, once you're making $100 a month, it's actually a lot easier to maintain it because the way the economics of membership communities work is provided you keep showing up and providing value in some capacity, you know, people have already signed up for the thing, so it's not too hard to maintain that level of support that you're offering them. For this business, we have a membership community for our part-time YouTuber Academy for the alumni, which is called the Part-Time YouTuber Inner Circle, and we make roughly $2,800 a week from this membership community. It's not very passive. We run like 3 or 4 events per week, along with like twice a day co-working events on Zoom, and we have lots of stuff going on, so it takes a lot of work, but $2,800 a week is pretty good for a membership community. All right, nearly there. So idea number 8 for generating passive income is creating a business that sells goods or services and then automating or delegating aspects of that business so that the income that you generate from it is reasonably passive. This is the stuff that Tim Ferriss talks a lot about in the 4-Hour Work Week, where there are a lot of businesses that you could make where you're selling a good or selling a service, and then you can delegate, outsource, automate in intelligent ways to make the income passive. So again, using my friend Oliver as an example, on his YouTube channel, he talks about his $1 million Shopify store. He designs, manufactures, and sells these really cool vegan leather kind of desk accessories and bags and mouse pads and that kind of stuff. And this was loads of work in setting up, but now he's got a team of 3 other people that manage the business. And so he spends proportionally less of his time running that business. And so it's sort of passive income for him, even though these days he still does spend around 10 hours a week maintaining things. Equally, if you're going down the service route, I've got a friend who runs an Instagram and Facebook ads marketing agency where he has clients who pay him I think a few $100s per month to manage their Facebook and Instagram ads. And for him, it's like a small amount of work initially to set up the Facebook and Instagram ads, but then it's sort of automated and he's got a team around it and he's using things like Zapier to automate aspects of that business so that each month he has to do a very small amount of actual work to keep it ticking along. So these are different ways of generating passive income from a kind of goods or service-based business, but it's quite hard to get started with this stuff. To get started, we're going to give this a 4 out of 5 star rating because, again, you need to create a business and it's quite hard to make a business that genuinely provides value. Equally, we're going to give it a 4 out of 5 star rating for making $100 a month in revenue because, again, you have to be able to provide value. And providing value is hard. Like, it's not as easy as making an account on a stocks platform and just putting some money in. You actually have to give value to people, which is kind of hard. But the nice thing is once you get started, like with anything, maintenance is a little bit easier. So we're going to give that a 3 out of 5 star rating. Finally, idea number 9 for generating passive income is to build an app or a website or some kind of software product that you can offer either as a one-off or more likely these days as a subscription service. And there's a whole category of this called SaaS, software as a service. Now, if you look at the website indiehackers.com, there are like literally hundreds of examples of people who have built software businesses that are making passive income, and they share their revenue numbers and they tell you how they got started and they give you their tips. In fact, I was recently interviewed on an episode of the Indie Hackers podcast, which is really cool because I've been listening to it for years and like been following their website for years. And I was interviewed around the concept of starting an online course like the Part-Time YouTuber Academy. Now, I've had a bit of personal experience with this. So when I was at university, I made a website called BMAT Ninja and UK Cat Ninja. So software as a service, it was a question bank for medical applicants applying to medical school to help them do well in the admissions tests. And this was something that me and my brother coded completely from scratch. He and I both know how to code. We learned when we were young. And so we worked over the summer of 2015 to make these things happen. I think in year 1, we made about $10,000. And in year 5 last year, it was around $25,000 from BMAT Ninja. So, you know, it's pretty good money, but it was a lot of work to set these things up. And so in terms of starting out, I'm going to give this a 5 out of 5 star rating because to make an app, it's actually quite hard. You have to know how to code for the most part. You have to be able to offer something compelling and you have to actually build it, which takes a lot of work and is very hard, but it's a lot of fun. And then once you've made it, I'm going to give $100 a month difficulty a 4-star rating because, again, it's easy, well, easy enough. You can make an app, but then getting people to pay for the app is an entirely different kettle of fish. So we're going to give that 4 stars. But the nice thing is, like with everything, maintenance is a little bit easier. So we're going to give that a 3-star rating. If you like this video and you want to get started with your own entrepreneurship-y, passive income-y generating journey on the internet, check out this short playlist over here, which is some of my favorite videos that I've made around tips for entrepreneurs, how I got started creating my businesses calculators from scratch, how I learned to code, that sort of stuff. That's all in the playlist over here. Thank you so much for watching, and I'll see you in the next video. Bye-bye.
Hey everyone, welcome to the Stock Market for Beginners complete tutorial. In this video, we're going to be going through step by step, showing you exactly how to get started investing in the stock market. Now, unfortunately, this is not something that we can learn overnight, but we're going to dump as much information as we possibly can within this video. As you can probably tell, it's a pretty long video here that we're delivering today. So I do urge you to treat this like it was a class or like you're reading a book and you're really trying to consume as much information as possible. So I recommend taking out a piece of paper, taking out a pen. Feel free to pause throughout so you can write things down. I have a pretty large presentation that we're going to share with you on investing basics, and then we're going to get more in depth as we go on throughout the video. And we're going to try to keep this in an orderly fashion, but feel free to skip around. Maybe perhaps you already know some of these things, so you want to go to the parts that you're really interested in. I will leave timestamps down below in the description in this video so that you can skip around, and also feel free to check out some of the resources and links that we have for some of the different stock brokerages down in the description as well. So I am incredibly excited that you're getting started with your investing journey, and we've had a lot of people request a video like this where we go more in depth on actually how to invest into the stock market. And what I've seen is that people sometimes like to get the low-hanging fruit. They don't want to know how to invest in the stock market. They just want to know what to invest into. This is how most people tend to work. So the fact that you're here watching this video, learning how to actually do this rather than just listening to other people tell you what stocks to buy, I think this can really be a valuable asset that you can hold for many decades to come. So a couple of quick notes before we get really deep into this. One of them, be careful with scams. There's scammers everywhere impersonating me. They're going to like reach out to you. There's all kinds of stuff like that. We have nothing here to sell you. There's no course. There's no upsell. You don't have to worry about that. I know sometimes it's annoying when I'm halfway through a video and suddenly somebody says, if you want to know all the information, buy my online course or my book or something. There's none of that. You can learn everything about investing for totally free online or at your library. I'm a huge advocate for that. So don't feel like you have to pay somebody to learn how to do this. I never paid a single penny to anybody to learn how to invest, and I think it's been going pretty well. So one more thing that we need to note here is that I'm not a financial advisor. I'm just a guy on the internet sharing things that I've learned, things that I've done. But I'm by no means trying to be some type of stock guru to tell you that I'm the best investor of all time. There's nothing along those lines. I'm simply just a guy sharing some information, and hopefully you find some value in it. And if you do, make sure you drop a like on the video, subscribe to the channel so that you can see more videos like this. And let's get started with the first point when talking about the stock market and getting started with it. Okay, so I'm going to be going through this presentation. I found it was a lot better to do this rather than just have the full screen of me talking. I'm just going to be up in the corner here and run you through this presentation. And like I said, I really do hope you are taking some notes on this, or at least screenshotting or starting to remember some of these things that we discuss in this video. So one of the first things that we want to focus on is looking at risk and return and trying to increase that gap between risk and return. Now, what I mean by this is how do we mitigate risk? How do we lower risk as much as possible while increasing potential returns? As much as possible. So if we can increase this gap, so we lower risk and we increase potential returns, that should be the focus. And sometimes I see people who maybe are going for high risk but low return investments. So you always want to be taking those two into consideration. How much risk is involved and how much potential reward is involved with any particular investment that we are thinking about making. Now, let's first just quickly go over some of the average stock market returns so that we can get a better understanding of where this type of investment might fall in comparison to maybe other types of investments like real estate or gold or cryptocurrency. And so the average stock market returns over the past 90 years for the S&P 500, we'll explain all of that later on exactly what that means, but it's been about 10% per year over the last 90 years. Now, this data can vary depending on which stocks you're looking at, but generally speaking, the overall stock market in the United States has grown about 10% per year. Now, this is not accounting for inflation, which can run anywhere between 2 and 3% per year on average. Now, this is very important to realize here that these are historical returns. This by no means is going to show you what's going to happen in the next 90 years. We really don't know. And we could see that the average stock market, if you take all stocks together and you combine them and you look at the average growth or the average decline, we really don't know what it's going to be in the future. But generally speaking, because society tends to move forward, we will probably see over a very long period of time, the stock market is likely to go up. But of course, nothing here is guaranteed. So you can see both these charts here. The green and red here is going to be the returns by year. So some years, the stock market might grow 30 or 40%. In other years, like what we saw in 2008, we saw the stock market decline about 40% in 1 year. So this was a pretty large decline. So it's going to fluctuate a lot. And what you'll learn with investing is that you do need to have some thick skin. When we say this, I mean that sometimes you want to be able to hold your investments through a lot of turbulent times. I have some friends who sold a lot of their investments at the peak of the pandemic last year in 2020 when it was April and their stocks were down 40 or 50% and they got scared and they sold. And now they look back a year later and they think, wow, I really probably should have just held through some of those turbulent times. So there's going to be a lot of turbulence. And the goal here, though, and what I'm going to be sharing with you in this video is how we can make sure that we're able to sleep well at night, because every night when I go to bed, I sleep pretty well. I'm not too worried, I'm not too stressed, and sometimes people will get too stressed over the stock market because they're over leveraged, or they're buying on margin, or they're doing something risky that maybe they shouldn't be doing. So we're always going to be focusing on mitigating that risk, but I wanted to show you these average stock market returns, and this is historically speaking, of course. Okay, now we want to talk about investing versus gambling. Now this kind of goes along with what we were just saying with when you're making investments. Our goal, my goal specifically, is to always focus on using logic rather than emotions when I'm making investment decisions. And the number one thing that I ask myself before any time that I make an investment is I say, Nate, am I investing or am I gambling? And this is always a question that I ask right before I click the buy button or the sell button. I ask myself, am I using logic or am I using my gut feeling? Am I going off of my instinct? Am I going off of what somebody told me? My friend sent me a DM and said, hey, make sure you buy this stock right now. So I'm always asking myself, am I making an investment or am I gambling? Because there is a massive difference between those two. And I really urge you to please catch yourself right now, especially if you're just getting started with investing. Catch yourself and make sure that you're making logical decisions rather than ones based on emotion, where somebody says that maybe a stock's going to blow up and you're going to triple your money in 2 hours. Just be very, very careful with that. And also the dangers of following the crowd. I try not to follow the crowd as much as possible, because if everybody's flowing towards one opportunity, maybe perhaps we end up in a bubble. And this is what we saw with something like the dot-com bubble. It's a really fascinating bubble that happened in the late 90s, early 2000s, where essentially almost any company that put .com at the end of their name would suddenly see their stock double or triple in price in a matter of days, because everybody was super excited about the internet. But this brought upon a massive bubble where stocks were incredibly overvalued. And so we'll go more into that a little bit and talk about the dangers of bubbles and following the crowd in general. And that's just something that I wanted to share with you on how we can limit our emotions. The best way to do this is take our time. I don't like to make rash investment decisions. And of course, maybe throughout this video here, when we're talking about the markets, maybe you will disagree with something, and that's totally okay. Some of this is based off of my opinion, not following the crowd, I think can actually pay off pretty well. But, you don't have to take everything exactly literal from what I'm saying here. And I think you know where I'm going with that. Just kind of show that I'm not a total professional. I'm not telling you that this is the specific way to invest. There's a lot of different strategies for investing, and people have succeeded with those. Okay, so now now we're going to get into talking about what a stock is specifically. And I'm going to read this off here and then we're going to go more in depth. So a stock represents ownership in a publicly traded company. So when you buy a company stock, you become a part owner of that company. So let's say that a company has 100 shares of stock and you buy one of them, you now own 1% of that company. And this is one of my favorite things when you understand what a stock is. I remember the first time I learned what a stock was, I think it was a 6th grade or maybe a 7th grade project where we had to learn about the stock market. And once I learned that I could own a part of a billion-dollar company and I could have a stake in that, it was just one of the most exciting things that I realized that, I remember when I was in 6th grade or maybe it was 7th grade, it was 2009, and going around just saying, hey, I own a little tiny piece of Google. I own a very small fraction of Walmart or Waste Management or Coca-Cola. And this was just a really fun thing to be able to think about when I laid in bed at night thinking that I am a part owner in one of these companies. So that is essentially what a stock is. They are bought and sold on stock exchanges. And so we'll talk about some of the best stock brokers and the ways to buy this specifically. But it's pretty easy to buy and sell. Now, this is all based on supply and demand. So, if I have shares of stock and you want to buy shares of stock, then I can sell those shares to you and we can transact that way through a stock broker, which, like I said, we'll talk about more in the coming minutes. Now, we do need to understand why companies issue stock and what's the purpose of this. Why would this actually have to happen? And it's so that they can actually raise money. And so a company can raise money by issuing stock. Maybe you hear about IPOs. I know Coinbase just had their new listing and they raised a ton of money. A lot of money has flown flooded into Coinbase because of their IPO, and this happened with a lot of other companies as well. So why companies issue stock is so that they can raise money typically, but let's look at the difference between stocks and bonds. You probably hear people talking about bonds. They're not really very attractive right now in 2021. A lot of people don't really want bonds because they don't have a lot of payoff at the moment. That might change. It definitely did. It's totally different from what it was in the 80s or the 90s. But stocks versus bonds, with stocks, you actually own a piece of a company, so you're getting a share of the revenue. You're getting a share of the profit. You own part of that company. But with bonds, if you are buying bonds, you don't actually own that company. You're just lending money to that company, and then that company's paying you back with maybe a little bit of interest on top. So that's the difference between stocks and bonds. Hopefully I could clear that up. And if you have any questions along the way and you're a little bit confused, feel free to just leave some comments down below, and I'll try to respond to you if I can. Just watch out for all the scammers and in the comment section. There's a lot of them. You can also just send me a DM on Instagram and I'll do my best to respond to you, but sometimes I do get a little bit busy, so hopefully you can understand that. Okay, so now that we understand what a stock is, it's just a really tiny fraction of a company that you own. Now let's talk about how to buy stocks. And so there's a lot of different ways to buy stocks. If we look historically, we go way back in time. If you wanted to buy a stock, you would have to find a way to talk to the company and buy the stock. You'd have to go through a stock broker, maybe to your bank. We're talking way back like 100 years ago. It was not super easy to buy stocks. Then as we progressed through times, then we started to see where you have your stockbroker on the phone. And when you think of maybe a movie like The Wolf of Wall Street and people on the phone with their stockbroker, that's what happened for a pretty long period of time. If you wanted to buy stocks, you would call your stockbroker and they would make the transaction for you. They would buy it for you. They would sell it for you. Now we've moved into the digital age where starting really, I would say in the mid 2000s, we saw this big surge of stock brokerage firms online where you don't have to talk to a broker. You can just click a button, press a button on your phone, and you can buy or sell stocks extremely easily. So, all right, so let's talk about some of the best U.S. brokerage firms, and then we'll talk about some of the best ones in Europe as well. Don't worry, I know I have a lot of European friends, so I'm not going to forget about you. Also Asia, Australia, Canada. It really does depend on what country you're in, and I don't know if I know all the best brokers in every country in the world, but I will give you some good ideas of ones that you can use to buy and sell stocks with. So If you are in the US, here are 3 ones that I would suggest using. You can pick from these 3. I'll leave links to each one of them down below so you can explore them and decide which one you want, or you could even open up multiple accounts and try them out and see which one you think really is the best platform to buy and sell stocks. The first one would be something like Robinhood. Not necessarily my favorite, but it's one of the most common, so I wanted to include it in this list. Then we have Public, very similar to Robinhood in a lot of ways, but they have a social feature onto it as well, so you can see what I'm buying and selling on that app on Public. And then M1 Finance is my other favorite investing app as well. And M1 Finance is really great for long-term investments, like if you're starting a Roth IRA and you want to have this for long-term investments, then M1 Finance is probably my go-to for that. So out of those 3, which one would I personally prefer? This really depends on the promotions that they're offering. So sometimes they offer a free stock or some type of freebie. If they are, I will leave that link down below as well with some of the best features and some of the best options available to you at the moment. And I'm recording this video in 2021 here. I don't know. If things are going to change, I will link to the best broker out there, because sometimes things happen with certain companies. They have problems. And so I will keep that updated as much as possible. Now, let's talk about if you are doing some passive investing and you want to invest in the stock market, but you don't want to think about what you're buying. You just want to kind of like set and forget and sort of do this passively. I would suggest using something like Wealthfront. So with Wealthfront, you're not actually buying and selling individual stocks. It's more so mutual funds and ETFs and long-term investments, and you're just telling them that you want to either be risky or not risky, and you can give them a couple of different options when you plan to retire, a couple of different options like that, and then Wealthfront can help invest your money for you. They take a really small fee, so I'll leave a link to them down below as well. They're a really great company. I've worked with them for a pretty long time, and so that's an option as well. Wealthfront for that passive long-term investing, and then the other 3, Robinhood, Public, M1 Finance, but there's also other options on top of that, like Webull and some other ones as well that we're not going to have time to talk about in this video. So hopefully I can make a review of some of my favorite investing apps as well. If I remember to do that, then that would probably be pretty good for you. Now let's talk about the best international brokers. If you're outside of the United States, what should you be using? Here's the basic rundown. eToro, it's pretty nice. I like eToro, and it's available in a lot of countries, so I would suggest something like eToro if you are outside of the United States and you're looking to start investing. They also offer a lot of crypto investments as well in certain areas, so make sure you read into the fine print to see what's available, what's not available in your specific region or country, but eToro is pretty nice. Other options, if you're in the United Kingdom, something like Trading 212 seems to be a great one. In Canada, we see a lot of people using Questrade. If you are in Australia, there's some great ones as well that I will link to. And there are some other ones on top of that, like DeGiro and Revolut and a couple of others in Europe as well. So you know what? I'm going to make another video for European investing apps as well, and for some of the other ones globally, because I know this is one of the most common questions that I get, and you could probably fix this by doing a Google search, but I promise you at some point this month I'm going to make a video just for all of my international friends who are looking to invest and what brokerage firm that they should use to start investing with. If you don't see it down in the description below, so that's what we're going to do for that. So those are the best brokers that you can use. Now let's talk about the types of brokerage accounts. We have individual accounts, we have joint accounts, we have retirement accounts like IRA accounts, and then we have custodial accounts. So an individual account is probably the simplest account. It's the one if you just want to buy and sell stocks, you can do that through an individual account. It's pretty straightforward. Then we have joint accounts. A joint account is, let's say that you have a spouse and you want to make an account together with somebody, then you can do that through a joint account. Now we have retirement accounts like IRAs. If you're going to sign up for an IRA and you want to put some money aside for retirement, I would suggest using M1 Finance or Wealthfront. I'll leave links to both of those down below as well. But those are both great companies for setting up some type of IRA or a Roth IRA. We do have videos on those specifically as well if you're confused about what an IRA IRA is. It's an individual retirement account. I do suggest having one of them, although, of course, I'm not a financial advisor. I'm just a guy on the internet. And then we have custodial accounts, which is also a great option for people who are under the age of 18, because if you're not over 18, you're not going to be, or sorry, let me correct that. If you are under the age of 18, then you can't sign up for these brokerage accounts like Robinhood or Public. You can't sign up for them on your own. You're going to actually have to have somebody who is 18 or older sign up for them and create a custodial account with you. This is how I started investing at a younger age, because I talked to my parents and they didn't really have a lot of understanding about what the stock market was, but I learned about it in school. I thought it was really interesting. I was a weird kid. I don't know. I just was like a bookworm. And so I was interested in it. And I had them help set up an account. So technically, it was my father who was on the account. And so this is not legal advice. I can't tell you if you are under the age of 18, you're going to have your parents do it for you, but you can consult with them and maybe talk with them and they can make the transactions and trades for you. That's what I did when I was younger. So those are the different types of brokerage accounts. If you're outside the US, you might see some different options as well. I don't know if I can help you with that because I don't know the specific laws in your country. They certainly do differ depending on where you are. Okay. Now let's talk about investing strategies. There are 4 primary investing strategies out there at the moment. And some people will argue that there's really only 3, but I like to include 4 here to give a better understanding and analysis of each one of these. So we have fundamental analysis, technical analysis, behavioral, and then we have dollar cost averaging. And each one of these has pros and cons to it, and we'll go over each one of these so that you can decide the type of investor that you want to be. This is a very important question. You want to ask, what type of investor do I want to be? What are my goals? Do I want short-term growth? Do I want to become a millionaire overnight? Probably extremely unlikely. Or am I looking for long-term growth, maybe 10, 20, 30 years, so that I'm set for retirement and my family's set when I'm older and I don't have to worry about how to pay my bills? So you want to think about your investment strategy, and you can learn more about this maybe through a number of books that we'll share later in this video as well. But let's talk about the first one, which is the most common, which is using fundamental analysis. This is also commonly used for value investors. And when I think of value investors or fundamental analysis, I think of Warren Buffett, which is this guy right over here. I think he's almost in his 90s by now. He is a little bit old, but he is one of the best value investors of all time, and he uses fundamental analysis in order to determine if a stock is undervalued or overvalued. And this is the whole goal of investing. We're looking for investments that perhaps other people have overlooked. And we're looking for companies to invest into. We're looking for stocks to invest into that are undervalued. So we're comparing their true value and we're looking at their true value of what we believe it should be by looking at the fundamentals, by looking at the balance sheet, the income statement, the cash flow statement. We're looking at the fundamentals of a company and the health of that company, and we're determining whether or not the stock is undervalued or overvalued, and there is a vast array of ways that we can make this determination, but this is going to be the primary focus in this video. We like to use fundamental analysis. I would suggest it, or at least understanding how to do fundamental analysis on companies, because this is going to be how you are determining whether a company is healthy or not. I sort of use a lot of these different ratios and financial metrics. It's similar to if you're going to the doctor and they're going to take your heart rate, they're going to take your blood pressure, they're going to look at your temperature, they're going to take a look at some of those important vitals. That's similar to what we do with fundamental analysis. We're looking at what's the blood pressure of a company, what's the temperature of a company. So we're examining the health of the company, and that's just a little analogy, hopefully, to help you understand that a little bit. But it generally is for long-term outlook, and that's what we use fundamental analysis for, especially when we're doing value investing. And so that's going to be the one that we're talking about in this video, which we will really delve into in the latter half. Now, there's another strategy, and it's known as technical analysis. Now, technical analysis is typically what you might associate with when you think of a stock trader, when you think of somebody who has 5 big monitors and they have charts everywhere and they have the bars with red and green, and you see that they're trading stocks. sometimes penny stocks, sometimes they're doing a lot of swing trading. But generally speaking, when we use technical analysis, it tends to be when people are looking to make short-term trades rather than long-term investments. And this isn't always the case, but it tends to be what we see. I would still definitely recommend learning about technical analysis because it can help you get into certain investments at certain times. So I do look at the technicals of stocks and I look at the charts to see when would be a good time to enter into that particular position or that particular stock. But generally speaking, I don't spend a lot of time with technical analysis because I'm more so focused on those long-term investments. And with technical analysis, it can take up a lot of your time. If you are a day trader or a swing trader, I don't have anything against this, and I honestly have a lot of friends who make money doing day trading, but there's a couple of problems that I see with it. And the biggest one is that it tends to take up a lot of time. You can't just sleep and have your investments grow. You have to be analyzing these charts and paying very close attention. So it's not really my cup of tea, but if it's yours, then that's totally great. Just watch out for a lot of the people selling their technical analysis, stock trading courses online somewhere. You don't need to do that. You can just pick up some books or watch some free videos on how to understand stock charts more specifically. Okay, so now let's talk about behavioral analysis and using social signals. This is my favorite way to determine whether a stock is something that I should buy or if it's something that I should sell. In behavioral analysis, it's relatively new, but what we're doing here is we're looking at human psychology, and we're thinking about groupthink within financial markets. So there is so much cognitive bias that happens within the markets. And so what we're doing here is we're making the assumption that there's a lot of irrational actors. Maybe we think that the market is not totally going to be efficient and that not everything's priced in, but maybe people act in fear. This certainly does happen. Look at a lot of market crashes in the past. We've seen stocks go down 80 or 90% because people were scared for no other reason for the fact that humans are very emotional creatures, and we can end up making money if we are able to understand and really disassociate from logic and from emotion, and we're able to separate those two. This is what a lot of behavioral analysis can really help with. And I'll give an example about a stock that I invested into using social signals was a company, Spirit Airlines, which a lot of people make fun of the airline because it's a very budget airline, but I bought this back in October and it's more than doubled since then. Now, sure, I've made some bad investments as well, but I used a lot of social signals and behavioral analysis to make this investment and make the decision that this was going to be a good investment for me to make. And so for social signals, we'll actually talk about this when we get into the how to find winning stocks segment. That should be maybe in 20 minutes or so on exactly how we use those social signals. Now we also have the fourth strategy for investing, which is known as dollar cost averaging. And this really does have some upsides, a couple of small downsides, but it's one that I think most people tend to actually use when they invest in the stock market. Now, dollar cost averaging, you are neutralizing the short-term volatility by putting money into the markets or maybe into one particular stock, but usually into large amounts of groups of stocks like index funds or mutual funds or ETFs. And people do this, they put money in maybe once a month or every couple of weeks, but they do this periodically so that they can sort of level out where they're putting money into the markets. So the great thing about dollar cost averaging is, let's say that if you are dollar cost averaging, you're putting money into the markets, say once per month, you're taking your paycheck and you're putting it into the stock market once per month. Well, maybe if there was a huge, it was at the top and you were doing this and it comes down, well, you were still putting money in all along this whole time. Now, if you weren't doing dollar cost averaging, let's say that you had $1 million, you just inherited $1 million, that's great, isn't it? Let's say that you take that $1 million and you don't dollar cost average, you just dump it into the stock market on one day. and that one day happens to be in August of 1929, and then for the next 3 years you watch that $1 million turn into $80,000 because you put it in at the wrong time. So dollar cost averaging helps smooth things out. That's why a lot of people do like it. And I would say the best thing about this is that it tends to be a pretty passive investment, meaning that you'll probably sleep pretty well at night, knowing that over a long period of time, the markets tend to increase over a very long period of time. That's not a promise, though. Just remember, that's not a promise. Anything could happen with the markets. And there's a common saying that time in the market beats timing the market. And so this is one of my favorite quotes as well to remember, and how difficult it is to really time the market. The only downside, though, of doing this dollar cost averaging passive investment strategy is you might miss out on some buying opportunities. I remember back in March of 2020, if I was just doing dollar cost averaging, I would not be putting very much money in when the markets had just crashed 40%. I saw a lot of deals that I could invest into. And so if I was just doing the dollar cost averaging, I would be conservative and I would only put in a couple $1,000s. But instead, I thought this was a little bit of an opportunity, so I dumped in a lot of money. It turned out that it worked out pretty well for me. So that is one of the only downsides there, is that you might miss out on some of those opportunities when you see stocks maybe dropped a lot and people are panicking and you're running towards that. Another one of my favorite quotes from Warren Buffett is to be fearful when others are greedy and greedy when others are fearful. So when everybody's running away, when everybody's panicking, this might be a buying opportunity. Not always, but it might be. So you want to make sure you do your research on that. So those are the 4 different strategies for investing. We have fundamental analysis, technical analysis, behavioral analysis, and dollar cost averaging. Hopefully you wrote down those 4 because maybe you want to use a collection of these 4. I actually use a collection of these 4 all the time, and I would suggest learning about each one of these and maybe using each one of them when you make investment decisions. Now, let's talk about active investing versus passive investing. We just introduced dollar cost averaging, so let's talk about the benefits and the downsides of each one of these. Now, first of all, we have active investing, and this is a strategy that I use for most of my money. This is conducting research, this is identifying risks, and you're trying to beat the stock market. You think that you are better than the stock market, or that you're maybe capable of finding better investments rather than just dumping your money into a big index fund that kind of tracks the overall stock market. So that's active investing. The problems with active investing, it takes up a lot of time. I spend at least 10 to 20 hours per week looking at the stocks that I own and making sure that everything's running smoothly, reading a lot of their financial statements, looking at the news for those companies so that I can make decisions and steer my ship of money, which isn't that big, but so maybe my small boat of money, and I'm trying to steer it in the right way. And with active investing, you know, it might be a problem because you might have rocks everywhere and you're trying to navigate with your little boat, trying to make sure that you manage your money properly. So it could be pretty risky. You might end up losing a lot of money if you do active investing, but over time, I think you really do learn a lot, and you could potentially beat the stock market. Now, passive investing, you're probably using some type of dollar cost averaging. This is typically into diverse asset classes and funds to mitigate risk. So you can put them into index funds or mutual funds or ETFs. And this might contain 500 different stocks or 1,000 different stocks or 2, 3, 4,000 different stocks that you are putting your money into, and it kind of spreads out among all of those different stocks. And the reason why people do this is because if you are dollar cost averaging passively into a lot of different companies, it's seen as a pretty safe investment. Because let's say that one of the 500 companies that you invest into, let's say that one company goes bankrupt. Well, you have the other 499 companies to maybe continue the upward trend, or at least kind of stay in business. So that's kind of the whole idea versus active investing, where maybe you only have 5 different stocks. One of those companies goes bankrupt. Maybe your investment portfolio just dropped 20 or 30% because you were too heavy into one specific company. Okay, so these are the three major indexes in the United States. We have the Dow Jones Industrial Average, we have the S&P 500 index, and we have the NASDAQ. These are three terms that I'm sure you've heard at some point in your life, people throwing them around saying that the markets are down 300 points today, or the S&P dropped 4% today. And so if you've heard these terms, people talking about this, whether you're just walking down the street and you hear somebody say this, or you're at Thanksgiving dinner, Christmas dinner, and somebody's rambling about how the markets are up 1,000 points or something is down, that's generally what they're going to be referring to is probably one of these three indexes. Now, these indexes are great for using as a reference point for how the overall stock market is performing. So the first one here is the Dow Jones. Now, this contains about 30 companies. These are very large corporations in the United States. A lot of these are referred to as blue chip stocks. So it's a lot of companies that you are probably familiar with. And if you want to know the exact companies inside of the Dow Jones, you can just do a quick Google search to see what companies are inside of it. But the Dow Jones, it's not actually one stock. It's not one company. It's just a way of measuring how overall the stock market is doing. So it's not actually a thing. It's just almost like a thing of your imagination. It's just a way of measuring. It's a way of tracking how well stocks are doing. And so then we have the S&P 500 index, which is made up of 500 companies in the U.S. These are also very large companies in the U.S. I know Tesla was just added to the S&P 500. So we have a lot of different companies within this, but this is probably going to be the best way of gauging how the stock market is performing. So if somebody was going to ask me, how have stocks been over the past year? I would use the S&P 500 index as a reference, and I would say, well, if the S&P 500 index was up 20% last year, then it's kind of safe to say that the overall stock market was probably up about 20% last year. So it's probably one of the best ways of measuring how the U.S. stock market is performing on a day-to-day basis and over a long period of time as well. Now we have the NASDAQ. The NASDAQ is it's generally going to be in a lot of technology, in IT. So you're going to see a lot of companies like Apple or Google in the NASDAQ. And the NASDAQ was really, really big back in the dot-com bubble in the late 90s, early 2000s when all these companies were something.com. We had Yahoo. So think of the NASDAQ. When you think of that, you're probably going to be associating that with a lot of tech companies, a lot of internet companies or software companies are probably going to be in the NASDAQ. But it's a great way to measure how tech is performing as well in the stock market. All right, so let's take a look at the 11 major sectors in the stock market. I recommend really focusing on a couple of sectors, and we will talk about how to find stocks, specifically how to find great companies. But what I would do, you have 11 different primary sectors in the stock market. I would focus on the ones that maybe you already have a pretty good understanding of. Maybe you have a lot of hobbies in something like financials. You're already really interested in real estate, perhaps, or telecommunication, IT, real estate, right? We have all these different ones here. We have energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and real estate. So I would suggest kind of focusing on a couple of these 11. Don't try to become a jack of all trades and understand every single thing that's happening within the U.S. economy. It's going to be really difficult to do that. So for me, I tend to focus on just a couple of them. So when you look at something like energy, people might be thinking that this is probably a lot of solar companies or windmills, but actually a lot of energy is going to be typical companies like ExxonMobil and British Petroleum and Shell. And so all of these are going to be very diverse, but every industry is going to have a different set of standards when it comes to what is a good or a bad financial ratio or metric, which is the next segment here when we talk about how to actually find good stocks and winning stocks. Okay, now I want to just briefly talk about mutual funds versus ETFs versus index funds. What's the difference? The good thing is that if you accidentally use one of these three terms interchangeably, it's not going to be the end of the world. They are very similar, but there are still some differences that you want to be aware of. Now, mutual funds tend to be actively managed. They tend to have a little bit higher fees than something like an exchange-traded fund, which is what ETF stands for. And I really don't put a lot of money into mutual funds. They're also not updated until the end of the day, whereas an exchange-traded fund is going to be updated at any given moment simultaneously, so it's going to be always updating throughout the day as certain ETFs are bought and sold. So an ETF generally does like to track index funds, so you can buy an ETF of something like the S&P 500. You can buy an ETF of the Dow, or you can buy an ETF of the NASDAQ. So it's a great way to invest into the overall stock market. If you wanted to say, you know what, I want to invest my money into the S&P 500, which is going to hold a lot of different stocks because I want to play it safe. Maybe I want to do this passively. I don't want to have to think about what I'm doing with my money. And then you put it into an S&P 500 index, which is going to be an exchange-traded fund. And so you can do this. It has pretty low fees. One ticker for that, just for an example here, would be VOO. So if you just typed in VOO into your stock brokerage app, you'd be able to find this index fund, which is going to be an ETF that would be in that category. So hopefully I didn't just make that more confusing to you, but exchange-traded funds tend to be the ones that I like to invest into. Mutual funds, you're going to have a little bit more money, a little bit higher of a barrier of entry to them. Sometimes you need $1,000 or $3,000 in order to buy into a mutual fund. So overall, I do prefer to have ETFs, which are also very similar to index funds, although you could have mutual funds that also are going to mimic index funds. Hopefully I'm not making that more confusing to you. If I am, feel free to just do a quick Google search on mutual funds versus ETFs. Now, let's talk about how to find winning stocks. This is going to be getting really into the details here. We're going to talk about a lot of different financial metrics, ratios, income statements, balance sheets. It's going to get really detailed. So I do urge you, make sure you are writing this down or pausing so that you can really let this marinate and think about as we go through this video. Now, how do we find winning stocks? This is my perspective. This is how I find winning stocks. People are going to have different strategies. Somebody might tell you to do something completely different, and that's okay. So this is not a prescription for you. This is simply what I do because I'm not a financial advisor, which I already said a couple of times throughout this video. Now, how do I find winning stocks? I like to focus on what I already know, things that I already understand. And I think this is a great starting point for anybody getting into investing. So what I think you should do is I would take out a pen, take out a piece of paper, and write down 5 of your hobbies or 5 of the things that you feel like you might have more knowledge than the average person about. Maybe you are really a car person and you love cars, you understand them very well, you understand everything about the car market. Maybe write that down as one of your strengths, something that you might know more than the average person about. If I had to do this, back when I started investing, one of the things that I started to look at was a lot of agricultural companies. Because believe it or not, I did a lot of agricultural stuff and I was into farming and I understood a lot of the different ag companies that were out there. And so because I had somewhat superior knowledge on that industry, that was one of my strongholds. And you can actually, make this for yourself if you don't know, if you're sitting there thinking that you have no knowledge about any industry or any sector, you don't have any hobbies, you're not good at anything, which I'm sure you are, trust me, you are. But if you're sitting there thinking that you're not good at anything, then go ahead and just pick a couple of different categories. Say, I'm going to learn a lot about amusement parks, or I'm going to learn a lot about the soft drink industry, or I'm going to learn a lot about the camera industry. And so you can start to learn more about those. But focus on what you know and focus on specific industries, specific topics, so that you're not trying to just be a jack of all trades. Because if you're trying to be a jack of all trades and you're going over here and you're looking at the swimming pool industry, and then you're looking at home builders, and then you're looking over at some new technology companies, and then you're looking at crypto companies, you're going to be all over the place. I try not to do that. Try to focus on what you know, but also I always do my best to try to block outside voices or hype. Look, if you're on Discord forums, you're on TikTok, and you're getting your stock investment advice from TikToks, be careful with that, because a lot of people have agendas. And even if you are Googling a company, let's say that you're thinking about investing into Coca-Cola stock, and so you Google Coca-Cola stock, and maybe you find an article about Coca-Cola stock, and it says, this stock is definitely a great company, you should buy it, blah, 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 here's why I'm buying it. Okay, it's good to read that and to understand their points, but remember, everybody probably has an agenda, and maybe that person who wrote that article about how great Coca-Cola stock is, maybe that person has a large amount of Coca-Cola stock and they want the price to go up. So just remember, everybody might have an agenda for themselves, and so focus on yourself and your money when you're making investments, and try to block out as many outside voices as possible when you are making investment decisions. That's going to be a very important step, because if you're just following everybody, you can end up at the top of a bubble. Like if you're buying, Tesla at thousands of dollars, and maybe perhaps it's in a bubble, I don't know if it is, then you can end up losing a ton of money because everybody's hyped up and everybody's excited about it, and you're following the crowd, following the herd. Now, this is how I find winning stocks. I focus on macro trends, and then I focus on the micro afterwards. So look at macro trends. This is how I found a company like Spirit Airlines back in the fall. Back when COVID was still raging and we had no vaccine, there were a lot of problems. Airline stocks were down a lot from what they were in the previous year. And so I was looking at the trends of the airline industry as a whole. And so I was looking at the macro trends. I was looking at the big picture. When we say macro versus micro, macro means big picture, right? So think of macroeconomics. It's going to be the whole economy. It's going to be large industries. And then micro is looking, under like a microscope. It's looking at the very specifics of maybe certain specific companies. And so identifying macro trends, one of them was, hey, you know what? It's the fall of 2020. When I had this thought, I thought, you know what? I think airlines have a really bright future. There's going to be a ton of pent-up demand for airlines in next year because people couldn't fly in 2020. A lot of problems with the pandemic, obviously. And so I was looking at a macro trend. I was saying the airline industry is going to see a massive increase in people who are wanting to fly. So once I identified that macro trend, I then said, now I need to look at the micro. So I know the airline industry is probably primed. It's going to be doing well in a couple of years. So let me now look at the micro and find 5 different companies in the airline industry and analyze each one of those 5 companies. And so this is called a top-down strategy, where you start with macro, then you get into the specific companies. You can also do a bottom-up strategy. This is not really as common, but maybe you are analyzing one company. Let's say that you start with one company, like you find Peloton stock and you're interested in buying Peloton stock, and you then start with that. You analyze that company, you think, it has really good fundamentals, then you can branch out and look at its competitors. You can look at the industry as a whole. So you can start micro and go macro, although I would prefer
With Fundrise, you can invest here from there, or there from here. Our platform gives you access to premium real estate that was previously only available to institutions.
Why is it that 400 plus people are profiting every single morning $500 to $1,000? The truth is actually very simple, and if you made it this far, you could probably guess what it is. It's copy and pasting what already works. Over the past 8 years, I've made well over 7 figures straight.
If you want to manifest anything in your life, a great place to start is with visualizing what it is you want. As Robin Sharma says, everything is created twice, first in the mind and then in reality. As energetic vibrational beings, as extensions of the one source of all that is having a human experience, we have some significant tools at our disposal which we can use to create absolutely anything that is desired. The first tool that everyone has is your imagination. This is your most powerful tool in your tool bag. It can be nurtured and developed even if you have been previously conditioned to not use your imagination for fear of being considered a dreamer. Life is a dream. You are the dreamer. This is your power. This is how new inventions have been made. People use their imagination to build a house, to create a beautiful picture or piece of music, to write a beautiful story or build massive businesses or empires. The creation starts in your imagination. The second tool at everyone's disposal is your focus and attention. Wherever you put that point of your focus, whether it be on another person, on a career, on a project, or your health and fitness, is what you are currently growing. If you are giving your attention to it, it is growing. You are feeding it with your energy. Some have their focus on default and are only giving their attention to the negative Nancy stories or all the things that are going wrong with their life or the lives of others. If your focus is on visualizing what you want, then what you want will expand and make its way into your reality. Your third power tool is your feelings. You don't need guidance from above. Your guidance is within you. It is your good feelings. That is how you know you are in sync with the source that is you. You can follow your good feelings to a life of bliss and fulfillment. Bad feelings indicate when you need to take a step back, change your focus, and become aware of what it was you were just thinking about that made your feelings start to go downhill. It will become evident that when you notice bad feelings, it usually follows a thought of doubt, worry, unworthiness, lack, or fear, however subtle they may be. When you notice that a thought you were just thinking has started to make you feel doubtful, sad, worried, or angry, when you feel that, that is when you make a choice. That is when you can say, okay, that doesn't feel good. It's time to turn away from that thought and focus on something else or nothing for a while. Because every thought you have is creative. It is creating your reality around you, and your feelings are indicating to you whether you are thinking about things that are going to give you a great, happy, blissful result that continue to make you feel good, or your bad feelings will show you when you're thinking about things that are not in sync with the immense power that is what you really are. Your fourth power tool is your motion. It is movement. it is action. There is an unmistakable element about living in this physical reality that doesn't exist when you're not human. In this 3D reality, action is the making of imagination. Action is the making of imagination. Saying yes to something, deciding, is action as well. It is a decision that allows action to follow. Inspired action is the ultimate form of movement. When we have inspired action, all expressions of ourselves are in harmony and alignment. Our thoughts, our feelings, our focus, and our movement become one synergistic, flowing wave. It feels like total bliss when we have all 4 elements of ourselves in one harmonious expression. Now let's bring this all together in a powerful guided meditation for visualizing what you want. Sitting in a comfortable position, place your hands in your lap or wherever is comfortable for you. Gently close down your eyes. Bring all your attention to your breath. Breathing deeply in and out. Feeling the air as it moves past your nostrils. Feel it as it fills your chest and moves all the way down to your stomach. Feel yourself relaxing as you breathe out, focusing all your attention on breathing in and out, and the feeling of your body relaxing. There is no force in your breath. You are simply observing your natural flowing state. Your natural rhythm. And noticing your body becoming more and more relaxed as you observe your breathing. You are an artist. You are the creator of your life. You are the creator. There are no limits to what you can live in this life, to what you can create. Know this to be true. You can live in any way you want. Feel your natural flow as you breathe, relaxing, feeling the love that is flowing to you right now in this moment. The love is saying you can have, be and do anything. You are supported. You are abundant in every way as you are right now. That includes and is beyond all forms of physical reality. You are limitless. I want you to imagine you are standing in front of a light large wooden door. You know this door is special. Behind it, your creator self has been busy assembling the most perfect house for you to live in, based on your unique preferences and desires. It is your soul's urge, your heart's desire, and now your creator self is going to show you what it is like to live there now. Like a painting that has come to life, the doors open and you step boldly into your dream house. You're standing inside your dream house now. Before we look around, bend down and take off your shoes. See your feet. Touch your feet. Feel your feet on the floor. What does it feel like? Is it nice, soft carpet, warm wood, or cold, solid tiles, or something else? Walk through your house. Walk through the rooms with bare feet, feeling the texture of the ground under your feet. Touch things in your house. What does your house look like? What does being in your house feel like? Do you feel relaxed here? Are you feeling excited? Do you feel comfortable? Do you feel expansive here? Does it feel bright and light or warm and cozy? Feel what it is like as you look around and spend time in some of the rooms. Sit in your favorite chair. Feel what it is like. What is the character of the chair? Is it soft or firm? What are you looking at while you are sitting in your favorite chair? Walk into the master bedroom. Open the wardrobe. It is exciting to see your clothes hanging in the cupboard. Yes, there is my favorite shirt and my favorite pants. Feel the happiness in your heart as you see your favorite pictures around the room. This is your house. I feel great in this house. I feel relaxed and at home in this house. I feel inspired in this great house that is perfect for me in every way. I feel comfortable and at home in this perfect house. I love being in my house. Go to the kitchen and get a glass of water. Suddenly you hear someone at the door. Your soulmate, the one you love and the one that loves you, has just come home. You swiftly embrace your partner, feeling what it is like to hold each other. You can feel your hearts beating together, so close. You can feel such happiness in your heart as you hold your partner. You are both so perfectly matched. It is like you can communicate with a glance, with a smile. You feel so at ease with this person, like you have known them for your entire life. They love and appreciate you for all that you are, and you love and appreciate them for all that they are. You feel a connection with this person that goes beyond anything you have ever felt before. Your heart overflows with love. You notice your friends and family are also arriving at your house. You notice something different. It's like you can only see the beauty in all of them, the perfection of who they are, the divineness of each of them. You are so happy to see them and to be with them. You enjoy being in your house with your partner, your friends and family, laughing, playing, enjoying each other's company. Now it is time to go to work. But it is not like a normal job or business. You are working from home or going to your place of work, which doesn't feel like work at all. You are so excited about what you are doing. You absolutely love what you are doing. You feel so inspired and invigorated by doing what it is that you absolutely love to do. It is not like work at all. You feel so blessed, so appreciative to be doing what you love to do. This is the most amazing job you could ever do. See yourself doing exactly what you have always dreamed about doing, what you have always wanted to do, with love, passion, and strength in your heart. It is like the perfect combination of all the things that you are naturally good at. All things you discovered since childhood that made you think, wouldn't it be nice to do that? Or I could do that. You are just being you, and people are appreciating and loving your unique talents and gifts. See yourself having an interaction with someone